with Mr. Direct or Mr. Meta.
Thank you, Commissioner Duffley. Duke Energy Carolinas would call Carl Newland back to the stand for his rebuttal testimony.
And Mr. Newland, let's go ahead and swear you in again. Left hand on the Bible, raise your right. Do you solemnly swear that the testimony you will give today will be the truth, the whole truth, and nothing but the truth, so help you God?
I do.
And Commissioner Duffley, actually, before we get started, the commission had asked when Mr. Newland was here on direct, I believe it was Chair Mitchell, but my notes failed me on this, for a reference in the record to the long-term debt issuances by DEC. And those are in section 34B of the E1s. So, and whatever is in the E1s is what they were as of the filing date. I don't believe they've got updated, although of course the cost of debt has been updated to the extent that the commission would like the updated long-term debt issuances as of the third supplemental testimony. We'd be glad to supply that.
Okay, thank you.
Mr. Newland, could you just restate your name and business address for the record?
Carl Newland, Duke Energy Corporation, 525 South Tryon Street, Charlotte, North Carolina, 28202. I'm the Senior Vice President of Corporate Development and Treasurer.
And on August 4th, 2023, Mr. Newland, did you cause to be pre-filed rebuttal testimony consisting of 32 pages and 9 exhibits?
Yes.
Were these rebuttal exhibits prepared under your supervision and direction?
Yes.
And are they true and correct to the best of your knowledge?
Yes.
Do you have any corrections to your pre-filed rebuttal testimony or the exhibits?
No, I do not.
And Mr. Newland, if I asked you the same questions that are set forth in your pre-filed rebuttal testimony today, would your answers be the same?
Yes.
Commissioner Duffley, at this time, DEC would ask that Mr. Newland's pre-filed rebuttal testimony be entered into the record as if given orally from the stand, and that his rebuttal exhibits be marked as pre-filed.
The rebuttal testimony of witness Newland filed on August 4th, 2023, consisting of 32 pages, will be copied into the record as if given orally from the stand. Exhibits 1 through 9 will be marked for identification as pre-filed.
Thank you, Commissioner Duffley. And Mr. Newland, did you prepared a summary of your rebuttal testimony, correct?
Yes, I did.
And Commissioner Duffley, the summary was filed in accordance with the Commission's direction in the 1276A docket. And we would ask that it also be placed into the record as if given orally from the stand.
The summary will be copied into the record as if given orally from the stand.
And Commissioner Duffley, Mr. Newland is now available for questions.
Okay, it looks like there's no cross-examination questions, so Commissioner questions. Chair Mitchell?
Good morning, Mr. Newland.
Good morning.
Just a few for you this morning. Have you reviewed the testimony that was filed by Mr. Walters on behalf of the public staff?
I have.
Okay. Do you have it in front of you?
I can get it in front
Okay.
of me.
And you may not need it. I just want it there in case you need to reference it.
Okay.
So I'm particularly interested in his testimony that begins on page 82 and concludes on page 84. It's under the section heading financial integrity.
Yes,
Are you there with me?
I'm there.
Okay. And to my recollection, Mr. Walters provided some live testimony to the same effect when he was on the stand last week. I'm not sure if you had an opportunity to hear his testimony then, did you?
I read a transcript.
Okay. So, do you, so let me do it this way. As I read his testimony and understand it, I mean, he's testifying that were the commission to accept his recommendation, which I believe is a 935 ROE, assuming the commission approved it in multi-year rate plan, and a capital structure of 52% equity, with 52% equity layer, that it would not negatively impact the company's DEC's financial integrity. He concludes that the company's credit metrics, utilizing his ROE recommendation and equity layer recommendation, would support an investment grade credit rating and mitigate cost to customers. Certainly, it is important to this commission to mitigate cost to customers. I think that comes as no surprise to anyone. So I just want you to help. Can you give me your response or your reaction, though, to Mr. Walters' recommendation and conclusion here
Yeah,
as
sure.
relates to financial integrity?
Sure. So Witness Walters focuses on S&P as the kind of the arbiter of what, the credit ratings would be. And so there's a couple of issues with that. So S&P is a major ratings entity, as you know. However, they use a family ratings methodology. So if you read their reports and you read what could lead to a downgrade of the Duke Energy complex, it focuses on the consolidated ratios of the holding company. So it talks about an FFO to debt downgrade threshold of 12%, which is what occurs at the holding company after everything is rolled up and the cash flows come up to the holding company. So he focuses only on DEC here. And while DEC is important, S&P takes a look at what happens at the overall holding company. Whereas in my testimony, I focused on what occurs from the Moody's rating agency, where they rate each issuer discretely. And so when I talk about the downgrade threshold at Moody's being raised to 21% as an FFO to debt at DEC, that is specific to DEC and not to the overall complex. He takes S&P's overall ratings methodology and then computes ratios to imply a 21% for S&P, which is not commensurate with the way that Moody's does it. So it's a little mixing of the two different methodologies. Second thing that he does is he's applying some sort of factor to get to just a North Carolina portion of the credit ratios. We certainly don't do that internally. We don't look at just North Carolina versus South Carolina. We look at it as an issuer, as DEC, because that is who the issuer is in the capital markets. And that's the way really both Moody's and S&P look at it as well. And so this factoring where he's applying, I think, a percentage of rate base to North Carolina retail portion specifically, I don't believe really has merit in terms of thinking about what the overall credit quality of the company would be going forward.
Okay. So you've already answered this question, but I'm gonna ask it. I mean, is it your recommendation then that the commission focus on the Moody's metric as you have when judging risk to credit quality?
Yes, I would.
And can you explain one more time why?
Moody's focuses its ratings, its analysis, its work on each individual issuer. So Duke Energy Carolinas is the issuer in the capital markets. They look at that entity, its cash flows, its credit profile as the entity, as the issuer. S&P looks at the family of companies. It starts at the top of the consolidated entity and lets those ratios filter down from there. And so I think Moody's just has a more specific criterion methodology when taking a look at what the credit ratings and the overall credit quality and credit profile of the company is when it seeks to raise capital. Can I address the affordability issue as well? The second part of your question?
You mean mitigating excessive cost to customers? Is that, yeah.
Yes.
Mm.
Yeah, so one thing I talk about in my testimony and that I would reiterate here is if you do come in and weaken the credit profile of the issuer, it might save some money up front, but in my opinion, longer term, as you have higher debt costs, as you face exogenous factors in the marketplace that could raise the risk of the company, I think ultimately there'd be a higher cost to customers as those are passed on versus having a strong credit quality and credit profile today.
Okay. Will you explain what you mean by exogenous factors?
Things that happen in the world that we can't control. So rising fuel prices, rising inflation, higher interest rates, pandemics, wars. It tends to cause volatility in the marketplace and raise rates.
Okay. And there's been some testimonies back and forth about credit quality and whether this commission should accept or take a risk on a lower credit quality because it comes potentially at a lower cost in the short run. You touched on some of that in your responses today, but what's your view on whether the commission should take that risk in the short run?
I think it would be risky to do that because I can see, mathematically you might get some near-term savings, but longer term, I believe that it would be greater cost to customers. The company is facing a heightened capital expenditure plan through HB 951. We're clearly facing higher interest rates. We're facing inflation. Plus all the other kind of factors we can talk about. And that leads to funding stress on the company. And the funding stress comes at a cost. And ultimately, those will be passed along to customers. Really I talk about in my testimony, the way to have insurance or, whatever analogy you want to make, is it a 30-year roof, whatever it is, it's good to have that in place. So as you go into capital market cycles that require higher costs of funding, that require higher capital bills like we're going into, just being able to have that strong balance sheet to weather the storm is important and ultimately will accrue to the benefit of customers.
Okay. And when you say strong balance sheet, is that the same thing as or associated with credit quality?
Yes, I'd say our current ratings would be indicative of strong credit quality.
Okay. 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 Thank you, Mr. Newell. I have nothing further.
Commissioner McKissick?
Just one quick question, Mr. Newland. I understand the distinction you're making about the holding company and the way Standard & Poor's works, the way Moody's works as relates to DEC. But in terms of Mr. Walters' characterization and his statement as it relates to, say, the holding company, would you take issue with what he has come up with or his assessment?
Well, I think I would take issue with the way that he did his analysis. I would take issue with really the implications of it because I think he shows a 21% FFO to debt ratio. And with the way that Moody's does or S&P does their calculation, which we don't emulate at the company, typically those results that they have are usually a little bit stronger than what we see coming out of the Moody's reports or the way we calculate our ratios. And in any event, that 21% that he cites would reference back to a Moody's downgrade threshold, not the S&P threshold. So I would take issue with the overall way that he characterized the analysis and the implications.
Well, thank you. That's why I was seeking that clarification since you didn't reach that point in terms of your earlier comments. That's helpful. Thank you.
Commissioner Commissioner Hughes, you have a question?
So I was just going to ask a question about all of these different quantitative and qualitative measures and metrics that we use. I understand from your testimony and from other testimony that there comes a point that it's too much of a cut in an ROE or in something that might directly short-term impact customer rates has this long-term debt cycle. But it's from what I understand from your testimony, it's lumpy. It's not a one-for-one, or there's some period where you get into an area that's really dangerous. So what we're really talking about is where is that sort of drastic dangerous area. And then it makes it tricky because a lot of our testimony is around what we're calling this reasonable, very narrow band. But then every once in a while, we get these what seem to be outliers where something bad really has happened. Do you have an example of in one of the other companies where you were caught off guard, the rating change, your cost of debt went much higher after a decision that was in that kind of close, reasonable, constructive range, as opposed to what we hear about as these, quote, punitive or out of bounds, or I mean, Mr. Walters was, I don't know if you heard him, how seemingly depressed he was that Arizona went much lower than his own recommendation. So there's that kind of, but when we're just talking about this, like, 10 basis points, do you just have an example of like where that, how fine a measure are we dealing with?
It's really difficult to put a point on some of these analyses in terms of exactly what a break point is. As you can tell from reading the material from the rating agencies, they have a combination of qualitative and quantitative factors, and so it's a little bit of a judgment call. But a recent example I would talk about is just the rise in fuel costs that we had last year when natural gas prices more than doubled. And with the natural gas in our fleet in Florida as well as in the Carolinas, that amount of fuel, while ultimately we pass through that fuel cost to customers, there are mechanisms that have it pass through later than after the point at which we purchase it. And so we've been purchasing gas at higher inflated costs, but only recovering much lower price, through customer rates. And that led to a very large deferred balance on our balance sheet, over $4 billion on a consolidated basis. And so we had to carry and finance that amount. And that's what led to a severe impact to our FFO to debt metrics in 2022. So remember, in the Moody's analysis, like they said, a fuel adjustment number was 21.3, kind of right at that downgrade threshold. But if you have the actual math and do the actual calculation, it's 16.8%. And so those type of events are shocks to the system that while the rating agencies might look through at a period of time, say for 1 year, they're not going to continually look through it. And so if there's an accumulation of events of commission decisions, events in the world, whatever kind of missteps you can think of that would be this combination of events, maybe a black swan event, if you wanted to call it that, something like that would occur could lead to unintended ratings actions when in reality, what the commission was trying to do was just save the 10 basis points. But by saving the 10 basis points and all these other things happen that weakens the credit quality, it could definitely impact the ratings. And the fuel is just one example. We saw higher costs during COVID. We see incredible costs with higher interest rates today. And so there's a lot of factors in the world that can lead to a weaker credit profile in addition to just what the commission decides.
All right, fair enough. In terms of what we collectively have a little bit more control over than things like the international price of fuels. I think if I understood some of Duke's concerns or threats or bumps in the road, at least the one I've read publicly, have been like you mentioned, the fuel. Do I understand it that the rating agencies, or at least Duke, has also been monitoring very closely the impact of these temperature swings, and in terms of unexpected mild winters that hit you on the revenue side? Is that in play as well in this? Should we be paying attention to that as well?
We definitely monitor that. It's definitely impacted our companies. The mild winter this past year, the kind of weak or off cycle weather we had the first 6 months, we definitely monitor it. And lower earnings that accrue from that, lower earnings and cash flow, weaken the credit profile as well. And so I think that's, one rationale behind, the multi-year rate plans and some of the other mechanisms that we've, talked about implementing to try and protect the credit quality.
What happened this past spring, summer, kind of with dealing with the mild winter? What would happen if that was next year? Is 951 providing a softer landing in that particular risk? I know with decoupling, I mean, has your team walked through the numbers, and would the revenue hit? I know there might have been a deferral, like you say, wouldn't have come in month by month, but as far as quote being made whole, have you run numbers? Is this going to protect you moving forward, the decoupling, to some degree?
So decoupling really doesn't solve the cash issue. It definitely smooths out the earnings issue, but it doesn't do that on the cash side. So there will be periods of over and under collection on the cash side, typically with a decoupled mechanism that we'll still have to work through. It just won't be as evident, I think. The multi-year rate plan, will reduce regulatory lag, so that should help the cash flow as we go forward, assuming that's implemented. So that aspect of 951, I think, does help.
And just the last question, because I think we talked some about some of the metrics and the challenges of trying to convey to the rating agencies the individual circumstances, because everybody they rate has individual circumstances. And have they been receptive from just a pure cash standpoint with some of these mechanisms, either with Duke or in other places, so that they would look differently at a quote weather hit? If, from a cash standpoint, something happening in a state with decoupling and without decoupling, the cash impact, I imagine, is quite similar. But then there's the big difference is one is a deferred, delayed revenue eventual collection, and one isn't. Does that ever come up with it, rating agencies, where they won't ding you if you have a mechanism that's in place that's going to eventually, quote, make you whole?
Each situation is specific when it occurs, but the rating agencies have commented that these mechanisms that are hopefully going to be put in place are, credit supportive. And so they're viewed favorably by the rating agencies, just as the way, a supportive commission is viewed favorably by the rating agencies. They continue to talk about, potential risks to the rating, including, other rider mechanisms that other states have that we may not enjoy, higher fuel costs, higher capital expenditure items, et cetera. So as is their typical want, they will, have a balanced view when they put out their credit pieces. And so they do talk about potential downsides as well as upsides in our ratings. But clearly they mentioned HB 951 and some of the policies in there that are supportive of the credit.
Okay, and that supportive is a good thing. Is constructive. That's also, I think, something I see. I don't know if they all use that, but that's a term. We want to be constructive. We don't want to be not constructive.
Agreed.
Okay. Thanks. That really helps. Yep.
Commissioner Kimmerite.
Good morning.
Good morning.
I'd like to just get some clarification to your testimony in response to Chair Mitchell's questions. what I heard is that you disagreed with witness Walter's reliance upon the S&P methodology, and you believed that the Moody's methodology was more appropriate.
Well, like specifically his allocation of a factor to just the North Carolina retail portion, I don't think is applicable. And then using the downgrade thresholds of 19 to 21% as it relates to the Moody's downgrade threshold, I think is mixing the two methodologies.
Yeah. And in your rebuttal testimony, I did see that you cited to both, your analysis cited to both S&P and Moody's. So can you explain, so my assumption from your rebuttal testimony and your testimony today is that you considered both S&P and Moody's, but that you placed greater weight or relied more upon Moody's. Can you help me to understand that so I can make sure that the record is clear in that regard?
Yeah, I think that's a fair assessment. S&P is a major ratings agency, and we pay them, the due respect that they require, and we enjoy the ratings that they give to us, and their analysis is usually quite good. However, they just have a different methodology. They have that family ratings methodology that starts at the top and it filters down. When we get to issuing securities out of each individual utility operating company, Moody's is much more specific and does the credit work, I'd say in more detail at the individual issuer company. So while we definitely look at both, we definitely spend time and analyze both, we do focus more on Moody's just because of the more discrete issuance requirements that they have.
Okay. Thank you for that clarification. And then further follow-up from Chair Mitchell's question to you. Can you just, you've provided information in your rebuttal testimony, but can you help the commission to better understand the practical consequences if Moody's were to provide a further downgrade to DEC? What does that actually mean for the company? And there's testimony in your rebuttal testimony, but if you could further elaborate, I think that would be helpful.
Sure. So if we were to have a downgrade, future issuance of debt would cost more.
Mhm.
So the credit spread over treasuries would increase as investors would demand a higher yield on those now lower rated securities. The existing portfolio of bonds would also sell off. So your yield and price is inversely related on fixed income securities. And so as the yield goes up, the price will go down. That has some portfolio management effects because a portfolio manager that owns the Duke complex of securities of DEC were to be downgraded, then the price of those bonds would drop and they'd have a negative mark to market, and portfolio managers don't like to show losses. Why that's important is when we come back the next year, we need to fund in the capital markets every year for these companies. As we come back in the next year and subsequent years, we'll go back to those same investment houses to buy our securities. And we do that, if they suffered a loss in the prior year, they're going to ask for a little additional yield, a little additional spread. I think I referred to the new issue concession in my testimony last week, which is just additional basis points on top of the credit spread that they will look for compensation for what they see as increased risk to buy those fixed income securities.
And just to finish it, and what does that mean for customers?
It would be higher costs ultimately as that higher cost of debt flows through to rates.
Okay, thank you.
Any more questions? Okay, questions on commission questions.
The public staff has some questions. If we had a downgrade in debt, well, let me start with what is the current Moody's rating for Duke Energy Carolinas?
Secured, so first mortgage bonds, AA3.
Okay, and if it went down, what would the next step be?
The A1.
So it would still have an A credit rating if we had one notch debt downgrade.
That's correct.
Okay. Now, let me talk about Moody's specifically, because I think that that's where you've been putting some focus. I hear a lot of the concerns that you have. I see of the zillions of pages filed in this case, only the public staff ran some numbers and came up with some percentages. I see the concerns that you talk about, but I don't see the numerization of those concerns. And so I'm looking at, for example, pages 82 to 80, the pages we just discussed, starting on 82, which then tie into the final exhibit, which was filed on July 19th. And in these documents, I see calculations that come in at 21%, which is the number that you're looking for. And that's at 935 and 52% equity.
That's the S&P methodology where he applies a factor.
I don't see where Duke did a methodology to tell me how that's wrong.
Well, I tried to explain in testimony why I feel that that's incorrect. I also feel that it's mixing and matching the two different rating agencies and the standards that they apply to credit quality of by the two agencies. And so the math that we ran, or the experience that we have at the company, is seeing activity in the marketplace by selling our securities, by seeing other companies in the marketplace with the capital structures that we requested for at the 53%, and ROEs in the Southeast that are in large part at 10% or better. And those were in my testimony.
Yeah, and you said a lot of things there in that answer, but I want to, I guess, have you forecast removing the volatile fuel component, which Moody's did? Well, let me ask it this way. Moody's took out, you said you were at 16.3 and Moody's said
16.8.
I'm sorry, 16.8. Moody's said, gosh, we know a lot of that's that fuel nonsense.
Correct.
So if we remove that fuel, we're at 21.3.
Correct.
We want to be at 21% or higher, correct?
Correct.
So we're now in the happy zone and we're at 52% equity and 9.6 ROE.
So the happy zone, as you call it, usually includes 100 basis point adder for events that are beyond our control. So the rating agencies will ask for an extra 100 basis points adder on top of their downgrade threshold, Moody's included. So you want to be above the 21%. You want to be somewhere closer to 22% because that 100 basis point adder, storms, et cetera. We do try to normalize fuel going forward, when we do projections, because it's hard to predict fuel, and you want to manage the company, based on kind of a standardized fuel look. And so we definitely, take a look at that in terms of projections and have a standardized look going forward. But in our analysis and in the rating agency materials that we provided, to be in that, that comfort zone above the 21% is more reflective of the ask of the 53 and the 10.4.
That is, I understand that you're stating that, but do you have a chart like Mr. Walters Exhibit 16 where I can look at it and go through your math and assumptions and fiddle with it?
Well, we provided is it the U1? The exact, I think it's called the U1. We provided that, and I think you have all our rating agency materials we provided, which provides a forward look.
In your testimony, there's no such chart as Mr. Walters filed.
No.
Okay. Let me move on to another topic, but I don't want to cut off your discussion if you'd like to talk about this one anymore.
We can move on.
Okay. If you'll give me just one moment. One more moment, I might be finished. Thank you. The public staff has no more questions.
Mr. Mehta?
Thank you, Commissioner Duffley. Mr. Newland, let's just take up where Mr. Freeman left off. And do you have your testimony, your rebuttal testimony, in front of you?
I do.
And keep the Walters testimony, in particular his very last exhibit, which is where he does his math.
I'm sorry, is that embedded in this testimony or is it attached?
It's actually attached. And I'm looking for the number.
16.
Yeah, CWW-16. CCW-16, sorry.
All right, I'm there.
In your rebuttal testimony at page 22, lines 10 and following, you talk about this cushion concept that you've testified to this morning and frankly last time as well,
Correct.
right?
Yeah.
And that's where the rating agencies look for this 100 basis point cushion to cushion the blow of some exogenous events. Did I get that more or less right?
Yes.
And if you go again in your testimony to page 5, right at the bottom of the page, you're actually quoting S&P with respect to this concept of a cushion, correct?
Yes, correct.
So the cushion concept is not just a Carl Newland concept, it's something that comes from the rating agencies themselves.
That's correct.
If you look at Mr. Walters's table in his exhibit CCW 16, is there a cushion portrayed in the figures that he came up with?
He came up with a row of FFO to debt on row 17 of 21.5 down to 21% based on the year.
And
So no, there would not be a cushion based on that math.
And in fact, he's right at the edge in terms of the latter years of the MYRP, correct?
If you think about the Moody's downgrade threshold, yes.
Yes.
Yeah.
Which I guess leads me to my other question. When Mr. Walters looks at a downgrade threshold applied by Moody's and then takes that into a analysis that he does based on whatever he did with respect to S&P, is that an apples to oranges comparison?
I would say that is, yes. And in addition, there's the factoring where he applies the North Carolina, I think it's a retail rate base to try and break the company into the different pieces between the two states.
And S&P doesn't do that.
They do not.
North Carolina retail basis, nor does Moody's.
Correct.
And S&P has its own methodology for assessing FFO to debt, and they do it on a completely different basis as Mr. Walters did it.
It's different. When the two companies, rating agencies do their FFO to debt, they will get a different number for each given time period. So they have some different methodologies and different adds and subtracts that they do. So they do get different numbers.
You mentioned in response to, I think, some of Mr. Freeman's questions as well as Commissioner Hughes's questions, the fuel fuel issue and the impact that it had on FFO to debt. And why don't we actually just look at the Moody's credit opinion, which is an exhibit to your rebuttal testimony. I believe it's rebuttal exhibit KWN-4.
All right.
And the chart right there in the middle of the first page is the FFO to debt chart for Moody's and its calculation of DEC's FFO to debt. Is that right?
That's correct.
And the one for 2022 does show that 16.8 figure that you quoted a few minutes ago, correct?
Correct.
But the note below the chart indicates that it would have been 21.3 once you factor in the deferred fuel, right?
Yeah, adjust for it. That's correct.
Is 21.3 a cushion, a sufficient cushion?
No, it'd be just 30 basis points above their downgrade threshold.
And on page 4 of the credit opinion, if you would turn there, Mr. Newland. There's a section called Financial Metrics Expected to Recover and Remain Supportive of the Current Credit Rating. Do you see that?
Yes,
And the current credit rating is an A-level rating, right?
that's correct.
And you mentioned in response, I think, to one of Mr. Freeman's questions that for the secured debt, even a one notch downgrade would still keep it in the A levels, right?
Yes.
What is the issuer rating for DEC currently?
It is A2.
Okay. So it's below the secured debt, which you would expect, correct?
That's typical. And so they actually have 2 notches between our secure first mortgage bonds and the issuer rating. Again, that's just some of their methodologies around their ratings grid to take it to A2 on issuer versus a secured basis.
And the first paragraph under that heading, financial metrics expected to recover and remain supportive of the current credit rating, indicates, and I'll just quote, Duke Carolina's historically strong financial coverage metrics have declined materially in recent years, including a ratio of FFO to debt falling from 25% in 2018 and 2019 to around 22% in 2020 and 2021 and 17% in 2023. Do you see that?
Yes.
And they go on to say that drivers of this decline have included coal ash spending, new generation and grid modernization, as well as the negative cash flow impacts of tax reform, the coronavirus pandemic, and unusually severe storms. Do you see that?
I do.
And in fact, Moody's references the storm-prone territory as one of the credit challenges that DEC has, correct?
That's correct.
They go on to say that going forward, they expect the company's credit metrics to recover from the low levels in 2023, correct? But they then say, and I'm quoting again, this is the second sentence, nevertheless, recovery of ongoing coal ash remediation spending, which still must be recovered via general base rate case proceedings, and elevated spending for grid modernization and grid generation transition investments will continue to maintain pressure on credit metrics. Is that right?
Yes, what it says.
And the grid modernization and generation transition investments are what are required by the passage of HB 951. Is that right?
That's my understanding, yes.
Mr. Newland, You were asked by one of the commissioners about an impact, I think it was Commissioner Kemmerite, about an impact of a downgrade. And you mentioned that there would be higher borrowing costs in the future as a result of the widening credit spreads. Do you recall that testimony?
Yes.
If you would take a look at, should be a book up there, I think it's all the way over to your right, called DEC, to your left, I'm sorry. DEC's potential redirect exhibits. And go to number 25.
Okay.
Commissioner Duffley, I would like to have potential redirect exhibit 25 marked as DEC Newland Rebuttal Redirect Exhibit 1.
It shall be so marked.
Mr. Newland, I think we saw something similar to this in the DEP case. It may have been from Scotiabank. This is from Barclays. But could you just tell us what this document, indicative new issue pricing, is?
Sure. So it's an investment bank underwriter, providing the treasury team at Duke Energy with existing bonds and where they trade from the Duke Energy complex, as well as what they view as comparable companies in the marketplace and where their bonds trade. And then on page, I guess, 3 of 5 on the exhibit, it's new issue pricing, where they lay out what they believe a new issue would price at in the marketplace as of the date of this document for all the various issuers listed on the page there. And they also include holdco pricing on page 4.
And holdco, you mean Duke Energy Corporation?
Correct.
So if you just take a look, I guess, on page 3 of 5, the one at the very top of the page is Duke Energy Carolinas.
Correct.
And as of, I guess, August 23rd, Barclays was indicating to you that we'll just pick the 30-year yields. You could expect a spread above the 30-year yields of 145 basis points, correct?
Yeah, 145 area.
Area.
Give themselves a little bit of room. So 140 to 150 maybe.
And let's pick another, a lower rated company in the family would be Duke Energy Ohio, for example.
Correct.
And for Duke Energy Ohio, the spread is in the 155 basis point area.
Correct.
And is
10.
that an illustration of what you mean by a widening of or increase in the spreads in the event of some kind of a downgrade action?
Yes, that's a 10 basis point spread, which is pretty typical.
And if you're buying, or if you're selling rather, 30-year bonds, 10 basis point spread would be not just for a year or two, it would be for 30 years, correct?
That's correct.
If you go back up to the DEC row, there is a row called reoffer yield. And under the 30-year bond, it is 5.72% area is listed. What is that?
That's just the coupon that the security would have if issued at par. So you take the underlying treasury, which in this example is 4.27%, add 1.45% or 145 basis points to get to the 5.72.
So the 5.72 is what Barclays is predicting, in effect, that of the interest that you would have to pay were you to sell a bond.
Correct.
For a 30-year bond.
Correct.
Give me just a moment here, Mr. Newland. Mr. Newland, I guess last question. In light of all of the questions that you've received today from commissioners, from Mr. Freeman, from me, what keeps you up at night?
Well, I'd probably just expand a little bit on some of the comments I made earlier about, overall activity. Like I called it exogenous events. I think DEC is a well-run company. We've talked a lot about its credit profile. The challenge is all of the various things that can happen if those were to, sometimes it's called a perfect storm or called a black swan event. If those things were to align, it could really challenge the credit quality of the company. And so, taken individually, they're usually, pretty manageable, but if they were combined, I think there'd be challenges to it. So for example, we've talked about the higher fuel costs, talked about the higher capital expenditure budget that we're facing, higher interest rates, inflation. And you can easily stitch together scenarios thinking about wars and floods and pandemics and all the rest. And so, usually trying to ride through a single issue, again, is somewhat manageable. But if there's a confluence of events, that's probably the only thing that really concerns me, is a confluence of events like that, could lead to, challenge credit profile. And, in my opinion, the best way to weather that storm is to have a strong credit quality going in so you can weather unforeseen events.
And I guess, Mr. Newland, we've actually seen a confluence of events very recently with the pandemic, with the war in Ukraine, with the rise in fuel costs, all happening simultaneously. Is that right?
Yeah, the higher cost of funds. That's correct. At least all those that led to a higher cost of funds. That's right.
Meaning rising interest rates.
Correct.
And even in the last few months, if you think back to the potential redirect exhibit 25, the indicative pricing, the anticipated yield that the Barclays of the world indicate that you're going to have to pay been increasing both for the 10-year treasuries or 10-year bonds and 30-year bonds that DEC typically would
definitely
would issue.
For the treasury. So we've had the hearing for DEP. I think the 10-year treasury is about 380, and today it's more like 420. So it's definitely increased over the past several weeks, which leads to higher debt costs. The credit spreads have been pretty much the same over the summer, but the underlying treasury has definitely increased in that interim period.
Is
Short-term rates as well, right? Including the short end of the curve has continued to be quite expensive as the Fed continues to tighten.
Is it fair to say, Mr. Newland, that DEC's ability to weather the storm is based on the strength of its balance sheet?
Yes.
And so customers rely themselves on the strength of that balance sheet.
Yes, I think that's a fair statement.
Nothing further, Commissioner Duffley.
Thank you for your testimony today, Mr. Newland. We truly appreciate it, and you may step down and you are excused.
Thank you.
Commissioner Duffley, I would move the introduction into evidence of Mr. Newland's 9 rebuttal exhibits. as well as the exhibit we marked this morning as DEC Newland Rebuttal Redirect Exhibit 1.
Without objection, that motion is allowed.
Thank you. And DEC would call next Mr. James M. Coyne.
Good morning, Mr. Coyne. Please.
Good morning.
Good morning. If you could, please place your left hand on the Bible, raise your right. Do you solemnly swear that the testimony you're about to give today will be the truth, the whole truth, and nothing but the truth, so help you God?
I do.
Mr. Coyne, could you just state your name and business address for the record, please?
Yes, it's James M. Coyne, and my business address is 293 Boston Post Road, Marlborough, Massachusetts, with Concentric Energy Advisors.
And in what capacity are you employed by Concentric Energy Advisors?
I am a senior vice president.
And on August 4th, 2023, did you cause to be pre-filed rebuttal testimony consisting of 37 pages and 4 exhibits to that testimony?
I did.
Were those exhibits prepared under your supervision and direction?
They were.
And on August 25th, did you cause to be filed certain corrections to your rebuttal testimony as well as to rebuttal exhibit JMC-2?
I did.
Did the corrections change any of the conclusions or opinions you present in your testimony?
No, they did not.
Do you have any additional corrections either to exhibits or pre-file testimony?
No, I don't.
And if I asked you the same questions that are set forth in your pre-filed rebuttal testimony as corrected, would your answers be the same?
They would.
Commissioner Duffley, at this time, DEC would ask that Mr. Coyne's corrected pre-filed rebuttal testimony be entered into the record as if given orally from the stand, and that his rebuttal exhibits JMC-1, JMC-2 as corrected, JMC-3, and JMC-4 be marked as pre-filed.
The rebuttal testimony of witness Coyne filed on August 4th, 2023, consisting of 37 pages, will be copied into the record as if given orally from the stand, as well as the testimony as corrected on August 25th, 2023, will be copied into the record as if given orally from the stand. The exhibits will be marked for identification as JMC 1, JMC 2 as corrected, JMC 3, and JMC 4.
Thank you, Commissioner Duffley. Mr. Coyne, did you prepare a summary of your rebuttal testimony?
I did.
And Commissioner Duffley, the summary was filed in accordance with the Commission's directions, and I would ask that it be entered into the record as if given orally from the stand.
The summary will be entered into the record as if given orally from the stand.
And Commissioner Duffley, with that, Mr. Coyne is available for cross-examination and questions from the Commission.
Okay, Mr. Connett?
Supervisor, no questions.
Mr. Freeman?
Good morning, Mr. Coyne. My name is Will Freeman. I'm with the public staff. Thank you, Commissioner.
Good morning.
How are you?
Well, thanks.
I'd like to ask you a little bit about one of your determinations regarding the appropriate equity for Duke Energy Carolinas. And I think that you made an Exhibit 4 to your testimony in which you went through each of the proxy group's subsidiaries and determined an equity percentage. Am I correct?
You are.
So I looked at that Exhibit 4 and I noticed there were some standouts. One of them, Evergy, was at 83.38% equity.
That's right.
And so
Book equity.
I understand.
Yep.
So I guess the point of your fourth exhibit was to tell us, was to say, here's a suggested equity ratio for Duke Energy Carolinas. It's currently at 52%, and you think it should be at 53% for rate-making purposes. And one of the reasons that you bolster that argument is saying, hey, look at the averages of the proxy groups, correct?
Well, I did not testify on the appropriate equity ratio for the company, but I did examine the evidence that was provided in that regard. And I used one of the methods that I use when conducting that analysis to determine the reasonableness of the recommended equity ratio. And one of the tests that I look at is to look at the book equity ratios of the subsidiary operating companies of the holding companies that are being used in the analysis. So that's the purpose of that exhibit, is to provide the benefit of that test here. And it's looking at the actual equity ratios of these companies, which are the peer companies to Duke Energy Carolina.
You're using a phrase, book equity ratios. Can you help me understand the difference in the equity ratio used for rate-making purposes versus the book equity ratios?
Yes, thank you. So the book equity ratio is the accounting measure of the equity that the operating subsidiary, and in this case, Duke Energy Carolina, would be actually carrying on its balance sheet. And I distinguish that, and that's something that we can measure and observe to see how the utilities are actually financing themselves. And it's important because when a credit rating agency, for example, or an investor is looking at the company, they want to know not just what has been authorized, but how the company is actually financing its operations. And that's distinguished from authorized, as this commission is deliberating in this proceeding, where it sets the allowed equity ratio. But we know that the way that these companies actually work is that they fund capital projects, and capital flows come and go in such a way that they are never precisely at their allowed. And sometimes those variations can be considerable. And you pointed out one example where Evergy Kansas South actually has an unusually high book equity ratio of 83.4%. They're much higher than their peers.
When we're determining the weighted average cost of capital, we traditionally take the rate-making equity percentage and multiply it by the return on equity, correct?
That's right. Yeah. This is a test of the reasonableness of the recommended equity ratio. And the average of this group, there are 60 companies there. You pointed out one is 52.94%, which I took as evidence that the recommended equity ratio of 53% is consistent with how these peer companies are actually financed. And some are higher or lower than they're allowed, but on balance, I think that 53% is reasonable. You pointed out the case of Evergy Kansas South, which is actually owned by Evergy Kansas Central, and they actually maintain an equity ratio that's closer to the average, somewhere around 52%. Some are actually maintaining lower equity balances than they're allowed, and some are maintaining higher. But on average, I think that 52.94% is a reasonable indicator of this group.
Well, let me then say two things. Certainly, you would never recommend, for rate-making purposes, that Duke Energy Carolina have a 83% equity capital structure, right?
No, I would not.
And then second, did you make a chart similar to number 4, where you looked at what commissions had ordered or authorized, as opposed to what was actually on the books when you looked?
No, and the reason for that is that we're looking for current evidence of how these companies are capitalized. And these companies, in some cases, only come in for rate cases periodically. In some cases, it's 10 or even 20 years before some of these companies have come back to the commissions. So if I were to take an allowed equity ratio for one of these companies from say 10 or 20 years ago, I don't think that's a good indicator of how that company should be capitalized today, because market circumstances and business risk have changed considerably. So it's typically not an indicator that I would use at the operating company level. Plus, you'd have to research 60 companies going back over time in order to do that.
Well, and that takes a long time, I will tell you, as someone who tried. But I did look at the 4 highest, and then I frankly ran out of time. But I looked at the 4 highest on Exhibit 4.
Mm-hmm.
And if you would turn with me, do you have the public staff's notebook at hand?
I have a copy of that exhibit with the 4 that you've looked at highlighted, so it might be the same.
Thank you. That's Public Staff Potential Exhibit 41, which Commissioner, I would propose to mark, which I would propose to mark as public staff. I apologize. Public staff Coyne rebuttal.
Cross-examination Exhibit 1.
Thank you.
It should be so marked.
And I think you said you had it in front of you.
I do.
And what I did was I tried to look through the rate case histories of those 4. The 83%, if you would like to turn, and if you would turn with me now to Exhibit 40. Do you have the long exhibit that has several hundred pages in it with you?
I do not have it in front of me, but perhaps Council could assist.
Do you have 41 and 42 at hand?
I have 42 in front of me.
Okay, let me get you to turn with Exhibit 41,
Okay.
which is a couple of hundred pages, and may Mr. Mehta approach?
Mr. Mehta may approach.
Thank you.
And while he's approaching, I propose to mark Exhibit 41 as Public Staff Coyne Rebuttal Cross-Examination Exhibit 2. Jackpot. First 20 in this book.
Okay, thank you.
Mr. Freeman, what was Public Staff Coyne Rebuttal Cross Exhibit 1? What was the potential exhibit number?
Potential 42 was Public Staff 1.
Okay,
And I
And-
apologize if I got that backward.
okay.
Potential 41 is Public Staff 2.
Okay, so you want to mark potential public staff exhibit 41 as public staff Coyne rebuttal cross exhibit number 2.
Yes, please, Commissioner.
Yes, it'll be so marked.
And if you'll turn to page 50 of 204 of that exhibit.
I'm with you.
And this was such a sort of recent thing that I didn't find in order, but this is testimony filed on behalf of Evergy, which is that one that was at 83%. And if you'll just look with me at page 50, you can see Evergy is looking for an equity ratio of 52.0376%.
I see that.
And I went through exhibit, which is now marked as Exhibit 2, finding the 4 companies here that are marked on Exhibit 1. And you see, I just putting those 4 companies into something lower than 60% brought the average down to under 52% equity. So when I now look at your exhibit, which I have taken 4 of the companies and just put their ROE, their equity structures from these 80 and 64% numbers to what they actually were set by the commission or anything lower than 60, now I've come up with a recommendation that Duke Energy Carolinas is above average at 52%.
I see what you've done.
Well, let's have a discussion with me, you, and the commission about why I think 52% is appropriate based on your calculations. And when I slightly modify them, I get a number that's less than 52%. So how do I square that up with the company's 53% request?
Right. Let's see if I can help with that. So what you've done is you've taken the 4 highest examples from these 60 companies and substituted, instead of their book equity ratios, their allowed equity ratios. And if one were going to try to make that comparison, one would want to try to take those that are actually operating below their allowed and put those numbers in there as well. And let me give you a few examples of where that's the case. For example, if you were to take the example of Southern California Edison Company, for example, you can see that in my comparison, their actual is 46.74%. And Southern California Edison is about 2/3 of the way down that list, if the commission is following along with us here. And this is in Cross Exhibit 42. And so if you go down about 2/3 of the way, you'll see Southern California Edison Company. And you can see the book equity ratio that I'm recording here is 46.74%. The authorized equity ratio for Southern California Edison is 52%. So that would offset some of the companies that are higher with some of the companies that are maintaining lower authorized equity ratios than those that are in their book equity, with those that are actually higher, have a higher allowed. So it's highly selective just to take 4 companies where there's a difference on one side without looking at the differences on the other side. So I think it's not very meaningful to take 4 companies and say that their actual allowed are lower than their book, compute a new ratio of 51.84% and suggest that that's meaningful analysis. What you'd really need to do is to do that to make the point I think you're trying to make for every one of those companies. So it's selective, and I don't think it's a fair comparison or a fair treatment of that exhibit. But if you were to do it right, and that is for every one of those companies, look at the authorized equity ratio, you'd be bringing in some very old data. You'd be bringing in allowed equity ratios from 10, 20 years in some cases. So I don't think that would be very helpful to the commission in terms of understanding either how these companies are currently capitalized, which is based on their book equity ratios, or how commissions are currently allowing equity ratios for these companies in current capital market conditions. So that would be the problem I would see with reaching that conclusion from just those four cases. And I can cite other cases as well, where their allowed is higher than their book equity ratios, but that's the point.
Yeah, and I tried to be clear that I just ran out of time and didn't have the resources to do all 60. So I think it sounds like, did neither of us do it that way then?
Well, I didn't for a reason, but if even with a lack of time, I think you can find some that are on the other side of the scale that would lead you to conclude that you really, to do it that way, you really need to look at all of them. But be mindful that it may not get you the number that you're really looking for.
Thank you. I take your point. I'd like to just turn to another topic if you're ready to.
Yes, sir.
Just some recent ROE orders that came out. Are you familiar with any of them?
I'll tell you.
Are you familiar with Tucson Electric Power, August 25th, vertically integrated electric utility, ROE allowed at 9.55%?
Yes.
Are you familiar with it and can tell us about it, or are you?
I was not part of that case, and I'm not here where it was reported. I know that prior to that, they even had a lower allowed equity ratio that led to a pretty significant downgrade and downgrade for the Regulatory Commission in Arizona as well as a result of it. But I wasn't part of either of those cases.
Avista Corporation came out on August 31st at 9.4% ROE. That's a vertical electric utility. Are you familiar with that award?
I know it was reported, but I'm not familiar with the case specifics.
Okay. Are you aware that Green Mountain Power, August 18th came in at 9.58% ROE?
Yes, I am aware of that. They're part of a formula rate plan in Vermont, and I'm very familiar with that case. That's, Vermont and Illinois are the two states that I'm aware of where they tie ROEs to treasury yields. And the treasury yields, as we know, have been very low. And as a result of that, those two states have had some of the lowest ROEs for their utilities as a result of those formulas. I would say unintendedly low in terms of their outcomes, but that's what's behind Vermont.
That's just the sort of three recent ones that I saw when I looked at the data. If you're aware of any from, well, I guess that's all of August, isn't it? Because it went through the 31st. So,
well, I think table 2 in Mr. Newland's rebuttal testimony is important because it summarized allowed ROEs for vertical. First of all, the utilities you mentioned do not look like Duke Energy Carolina in terms of their business profile, their operating profile, their generation mix, and things of that nature. And what I like about the table 2 that Mr. Newland prepared is that it summarizes the allowed ROEs for companies like Duke Energy Carolina that operate in this region under reasonably constructive regulatory environments like DEC. And those decisions look very different from the ones that you cited. You can see the average in this table is 10.2%. And in that table, you have decisions like Florida Power and Light that was allowed it's now a 10.8% return because of the adjustment for treasury yields built into that decision. And that's on a 59.6% equity ratio. And Georgia Power has a 10.5% allowed ROE on a 56% equity ratio. And I was involved in both those cases, so I'm much more familiar with what went into them. And I think the risk profile of those utilities with storm risk, their generation profile, and their need to decarbonize generation fleets, and a lot of work to do to reach those objectives make them much better comparators than I think the few cases that you've mentioned.
well, it was my understanding that Duke, when sort of looking at ROE, took a nationwide view of things. Certainly, we've heard a lot about other jurisdictions and their risk. And so aren't you sort of looking away from the nation when you found some higher numbers closer to North Carolina?
Well, I think you start just as Dr. Morin and Mr. Walters did in their analysis with a national view of the electric utility universe. I think that's an important and appropriate place to begin the analysis. And then you screen based on their business profiles. But if you want to look at averages, I think it's more important to look at companies that look more like Duke than the companies that you've suggested.
If I could have one moment. Just one more moment, Mr. Coyne and commissioners. I think. Thank you, Mr. Coyne. I don't have any more questions. I appreciate your time.
My pleasure.
Redirect.
Just a couple, Commissioner Duffley. Mr. Coyne, Mr. Freeman was asking you about what's been marked now as public staff Coyne rebuttal cross-examination exhibit 1. It's the potential exhibit 42. And in your conversation with him, you indicated that it was selective, highly selective, to take 4 companies with the highest ratios and then substitute in the authorized, the highest actual ratios and substitute in the authorized equity ratios, correct? You recall that testimony?
Yes.
And you indicated, I think, that it's not a very meaningful comparison, correct?
That's right.
Would you characterize it as another apples to oranges comparison?
Yeah, very much. You would typically not mix authorized with actual because of the timing differences, and they tell you different things. One's telling you how the company is actually capitalized, and the other is telling you at some point in time what the allowed equity ratio was for the company. You would typically keep them separate when you're reporting them.
Nothing further, Commissioner Duffy.
Commissioner questions? Chair Mitchell?
Good morning, Mr. Coyne.
Good morning.
A few questions for you. I'm going to start with questions on related to DCF. In your testimony, you offer several critiques of Mr. Walter's application of the DCF. Can you walk through those one more time at a fairly high level?
I will, yeah. I want to get to the chart I actually had that made those comparisons. There are a couple of versions of Mr. Walter's DCF analysis that I take issue with. There are two fundamental issues with the approach that he's taken in some of his iterations. He uses conventional approaches in some cases and unconventional in others. And where he uses unconventional approaches, it's yielding results that are very low. And I'm taking issue with both the results he's attained, but those are really a factor of the methodologies and inputs that he's employed. Let's start with the multi-stage DCF version, and maybe I'll just back up because I think when you start to talk about these models, it's useful to get grounded in what we're trying to accomplish with them. So the discounted cash flow model, or the DCF, is fairly straightforward in the grand scheme of things. It says that the investor's required return is equal to the dividend yield that you get on owning that stock, plus the expected growth you're going to get in income from owning that stock. So that makes sense when you stop and think about it. When you buy something, you're going to get dividend yields, so you're going to get a cash dividend from owning it, and you're going to expect that the value of that stock will grow over time, and your earnings or your dividends will also grow over time. So that's what's going into the DCF model. So it's important when you use the DCF model to make sure that the assumptions you use regarding dividend yields, the first component, and the growth rates, the second component, are reasonable. And for most of us that do this work, and I don't have a real issue with how he's solving for the dividend yield. He's taking recent stock prices, recent dividend yields, and that's pretty consistent with how most of us would do this work. I don't have any fundamental issues there. But what I have issues with are two versions of his DCF, and he solved for three, where he's used what I consider to be unreasonable growth rates for earnings. And if you use an unreasonable growth rate for earnings, then you're going to get a lower reported result from the DCF because you're buying an investment that will have a lower earnings growth rate than it would otherwise. So now to get to the specifics.
May I, before you get to the specifics, I'm going to follow up with one question. He characterizes your growth rate as unsustainable, as I understand his testimony, and you characterize his growth rate as unreasonable, unreasonably low, or just unreasonable. Help me sort through those differences in characterization. Why is I'll leave it there.
Right. Good question, Chair. Well, first of all, it was actually Dr. Morin's analysis that he was criticizing. Yes. But
Fair, and that's my
right. But I can speak to Dr. Morin's analysis. I've studied his work and try to answer the question for you as best I can. So Dr. Morin relies primarily on earnings growth rates from analysts, and he uses two different sources. He uses Value Line, and Value Line hires analysts that study these companies, and they come up with projected growth rates for earnings and dividends. And he also uses the consensus forecast of earnings growth from equity analysts that study these companies, and companies like Zacks and Yahoo Finance contact these analysts, ask them what their expected earnings growth rates are, and then they pull together a consensus. So one case is value line, the other case are consensus growth rates. And that's the industry standard and what we typically see in regulatory proceedings. All would agree that these analysts study these companies, they know what they're doing. And therefore, it's a reasonable place to look for an earnings growth projection to go into the DCF model. Mr. Walters, however, takes issue with those earnings growth rates, and he substitutes two different versions of the DCF model, two different versions of those growth rates. One is the sustainable growth rate. And it sounds good, the sustainable growth rate. But what he does in deriving that sustainable growth rate is he takes from value line. So this is the company that's providing these forecasts of earnings and earnings growth. But instead of taking that forecast, which he could have done, as Dr. Morin did, he's taking pieces of their forecast and putting them together to come up with a lower sustainable growth rate. And whereas he already has the earnings growth rate coming from value line. And interestingly, one of the pieces that he's taking in order to compute that sustainable growth rate is the projected ROE that value line has for each of these companies. And those projected ROEs for these companies on average for the same proxy group that he and Dr. Morin are using are over 11%. So he could have taken those projected ROEs, but those are projected earnings ROEs as opposed to authorized. He could have taken the projected earnings growth rates from value line, but instead he took pieces of their forecasts, put them back together and created a sustainable growth rate, which is much lower. So there is no reason to decompose the value line work that way, in my view, and create this lower sustainable growth rate. And I believe that that's one of the problems with that version of this model. So that's the issue there. And that produces a result of 8.72 to 9.02%, which is much lower than what you would get if you just used the earnings growth rates as Dr. Morin did. The other methodology that he employed, again, in order to project earnings growth, is what's called the multi-stage DCF. And the multi-stage DCF is based on a premise that whatever your short-term earnings growth rate is will not stay in place forever. And it allows you to substitute some longer-term growth rate that you think is a better version of that growth rate. Most people that would specify a multi-stage DCF model would use a short-term earnings growth rate from analysts. Mr. Walters did that. But what he did is he substituted a GDP growth rate in the long term of 4.3%. And that 4.3% is much lower than the analyst growth rates for these companies. And as a result, it brings those DCF numbers down. Analysts project growth, value line or the consensus growth rates are between 6 and 7%. So if you substitute a 4.3% in this model, you're going to bring the numbers way down. Intuitively, let me just talk about why it doesn't make sense to think about GDP as the long-term growth rate for a company like Duke Energy Carolinas. Because these are companies that need to make considerable investments. We're at a turning point in the industry in terms of decarbonizing their systems and building out a new and modern grid, substituting solar and wind for fossil-fueled resources are going to take considerable investments. Those investments will drive earnings growth much greater than GDP. I've looked at this issue many times, and every time I have looked at earnings growth for utilities in relationship to GDP, I find that historically their earnings and dividends growth routinely exceed GDP growth. So it's a fairly blunt instrument to suggest that for some reason the industry all of a sudden is going to revert to GDP when historically it has grown faster than that. And we also do this, in addition to this work that I do before regulatory commissions and we do as a firm, we also work for companies that are looking to invest in utilities. And when they come to us and ask us, for example, what is the expected future for, let's just say, Duke Energy Carolina, I would never say to them, let's just look at GDP. because that's going to give you guidance about future earnings growth. What you have to do to understand the earnings potential of a company is to look at what's driving its rate-based growth, what's going on in the economy of the service area, how fast can you expect it to grow income and earnings. And it would be a surprise to me if you were to take a well-run company such as Duke and assume that that's going to be the limit of their earnings growth over time. So it's on both of those, the sustainable growth rate version and the multi-stage are unreasonably conservative. And as a result of that, they bring those two versions of this DCF model down and therefore lower the end of the reasonable range produced by its results. I mentioned beta well, I'm sorry, that's the Cap-M model. Maybe we'll get there, but those are my critiques of his approach on the DCF side.
Okay, thank you for that, for your testimony there. And you actually anticipated, I had several more questions on DCF for you, but you anticipated them in your response. But one last question on DCF. The companies covered by the Arno and Asness study, I may have not said those names correctly, that you cite on page 17. Is that, are you remembering that study?
I am.
Okay.
Yeah.
Is there a reason to think that utilities might behave differently given the regulation under which they operate relative to the companies cited in that study?
No, I think what that study was illustrating is that the premise of the sustainable growth rate is that you can take a payout ratio for a company. The argument is that the more a utility retains in terms of its earnings, the faster it will grow. And what that study was showing is that the reciprocal is actually true. You will not show that the sustainable growth rate model tracks what actually is going on with the market value of stocks over time. So it's not a relied upon version of the model because you can't find good market evidence that would support that it's actually true. I'm not aware of any regulator that has adopted the sustainable growth version of the DCF as one that it will place primary reliance on.
Okay, thank you for that response. All right, moving away from the DCF, page 12 of your testimony, you discuss the mitigation of ROE reductions in the 2020-2021 time period due to concern for or the perception of the artificial suppression of interest rates, given what was going on at that point in time in the economy at large. To what extent should this commission factor into its decision when comparing its authorized ROE in this case to, well, let me say the question differently. To what extent should the commission factor this potential for past artificial suppression, mitigated ROEs, into its decision in this case? When it considers DEC's prior ROE of 9.6. Does my question make sense? I can say it again if not.
It does to me.
Okay. It's not going to be clear in the transcript, but go ahead and answer.
Right. Well, let me rephrase your question just to make sure I have understood it. When you look at historic allowed returns for companies such as DEC, should you factor in the market circumstances that would have been operable at that time in terms of reaching those decisions, including interest rates and the role that the federal government was playing in terms of depressing those interest rates in order to recover from the COVID pandemic? That's how I understood your question.
And that's a fair interpretation.
Okay. I wonder if I can take you to a potential cross exhibit that we developed that might help put this in perspective. And with permission, it was labeled as redirect potential exhibit 26, if I'm not mistaken. And let me look to council to see if I could actually refer to that.
I think that's a DEC potential redirect exhibit. Number 26.
Okay, and are you doing it for illustrative purposes at this point?
I guess at this point, but
Thank
at some
you.
point, I'll probably put it into evidence if we talk about it.
Will you restate the number that you've referred to?
Redirect potential exhibit 26. Yeah.
Okay, I'm there.
So, Commissioner, you referred to the last decision for DEC, which, and the final order was issued as it shows on this chart in March 31st of 2021. And at that point in time, 30-year Treasury yields, if you look to the right, were 2.31% and projected were 2.23%. So the commission was operating in the environment at that point in time. We were in the middle of actions by the federal government to depress those interest rates, as reflected in those pretty low Treasury yields from historic standards. So if you look at the decision that this commission made of 9.6%, clearly it would have been factoring in those very low interest rates at that point in time, and it would have influenced the analysis provided to the commission. If you look at where we are today, and you can see that when the current case was filed, that same 30-day average was now 3.7%, and that's because the federal government has started to undo the actions that it took to stimulate the economy. And as of August 22nd on that chart, you can see that the 30-day average was 4.13%. And I checked last night and it's currently at 4.29%. So what's happened, to put that into a response to your question, is that just as I would look at that 9.6% as influenced by what was going on with the Fed at that point in time, what was going on with the economy, those actions have now been pulled back. And as a result of that, we're getting back to something that's no longer a deliberately stimulated and deliberately low interest rate. Inflation levels are still higher than the Fed's target, but they're starting to come down. They come down considerably. So I think that you need to consider that 9.6 in the context of what was going on then. But I think that the market evidence that you have before you today reflects a more realistic and current market environment to inform this decision. Interest rates are, the A-rated bonds for utilities are 2.03% higher since that last order, and interest rates for BAA rated utility bonds are over 2% higher since that last order. So I think all that, those are important considerations as you think about this record versus that record.
Okay, thank you for that response. The next subject matter for you, Cap-M. With regard to the Kroll method used by Mr. Walters in his Cap-M work, you state it's not clear that the market risk premium and normalized risk-free rate are generated in tandem. Can you explain further here? Help me understand exactly what you mean there.
Right. What we would expect and what you can observe statistically is that interest rates decline, the equity risk premium goes up in order to keep equity investors appropriately compensated and vice versa. And what I've illustrated in figure 6 in my rebuttal testimony is that doesn't appear to be the case with Kroll. Because the upper line shows this is their equity risk premium that Mr. Walters has relied on in relationship to interest rates, and there's no apparent statistical relationship between them. Whereas if you were to run a regression analysis of the market-based equity risk premium, you would find an inverse relationship. So as interest rates go down, the equity risk premium comes up. The Kroll equity risk premium, which is so fundamental to the CAP-M model that Mr. Walters has relied on that case, is only 5.5%. And that produces a very low result, and in between 8.4 and 8.76% If you were to, and what Mr. Walters did do, and I give him credit for this, is he did use some reasonable approaches, but it's just that these other approaches brought down the average of his results so much that the overall recommendation, I think, is unduly biased by them. If you were to do what FERC does and to estimate a market equity risk premium using a DCF model with analyst growth rates, as we talked about earlier for the DCF model, that would produce, and this is his own analysis, a 10.68% total market return, less a 3.7% risk-free rate for a 7% equity risk premium. And that is consistent with the long-term history for the market equity risk premium. If you look at the Kroll also publishes that history of market equity risk premiums, and that historical return is one of the ones that Dr. Morin relied on. And that number is 7.17%. So from the same source, Kroll, they went back and looked at actual equity market returns from 1926 through 2022. And that historical equity market return is 7.1%. So it's odd to me that you would pick this number from Kroll, which is their current estimate of 5.5%, and not consider that long-term history, or put more weight on the FERC forward-looking, the FERC methodology forward-looking market equity risk premium, which is, as I mentioned, 7%. So if you look at the table, and I know you asked him about this, if you look at the table of his Cap-M results, some of them are reasonable. If you look at the reasonable inputs to the Cap-M model, I would turn you to page 73 of his testimony. And in table CCW11, he has a risk premium method using current value line betas, and the FERC DCF method using current value line methods. And in those two approaches, Mr. Walters, in my view, is more mainstream with the inputs he's using to these models. And also, it gives you results that I think are more in tune with what you would expect for a utility like Duke today in terms of its required cost of equity capital.
All right, thank you, Mr. Coyne. All right, I've got a follow-up question for you there, and this one comes from commission staff and is not my own question, so it's getting down into weeds that are less familiar for me. But so you criticize the betas that Mr. Walters uses in his Cap-M, and as we understand, adjustments that you make reflected on page 36 of your testimony, you appear only to exclude the Kroll method.
Was it page 36 of my testimony, or was it Dr. Morin's? Let me just double check.
I think, well, my assumption is 36 of your testimony.
Just double check there. I see. I'm with you.
So help me understand why you made only this one adjustment to exclude the Kroll, but not the
beta.
taking issues with.
Yes.
Okay.
Yeah. Let me again rephrase your question and make sure I
Okay.
understood it. So I've taken issue with both his approach to beta. The two fundamental inputs to the Cap-M are beta. The three inputs are the risk-free rate. He used a consensus forecast. I have no real issue with that. The other two inputs are the market equity risk premium, which we just discussed, and using the Kroll method provided too low of an input to that model in my view. And the other input is the beta. And he used three different approaches to beta. And as you can see, going back to his table, that the different betas that he used do make a difference in the results, but not as big of a difference as substituting that Kroll method for the market equity risk premium. But the issues, I should speak as I did in my testimony to the issues I have with this approach to beta. I have no issue with his use of the current value line beta. It's a well-regarded source investors rely on. And it's one of the sources that Dr. Moore relied on, as I recall, as well, and I would rely on it. But I have never seen what he has done here in terms of a historic value line beta, where he's gone back over 10 years, bearing in mind that the cost of capital is a forward-looking estimate. But there are times we're stuck with history as providing the basis for those estimates. So the standard compromise is to look at 5 years of history, and that's how value line approaches it. Some argue that you should look at more recent betas, even 2 years. But to go back 10 years means that you're going back to, as we sit here today, you're going back to 2014. And then you're basically suggesting that the industry risk profile in 2014 is representative of what the industry risk profile is today from an investor standpoint. And I can't think of an investor that thinks that way, because so much has changed that's fundamental to the utility industry in terms of decarbonization, the need to modernize the grid, fundamental changes in how consumers consume electricity and gas for that matter. All these issues are pointed out in analyst reports and credit rating reports that suggest that 10 years is pretty old when it comes to looking at the electric industry. So that's why I would take issue with what he's done with a 10-year historic value line beta, which are lower and produce lower results. The other methodology that he uses is the Vasicek adjusted betas, which is in academic circles, it's explored, but it's not used as a fundamental approach in my experience in regulatory proceedings for these purposes. Instead of comparing how a stock price moves to the overall market, which is what a beta does, and that's how Value Line does it, that's how Bloomberg does it. With this Vasicek adjustment, what you're doing is you're choosing some other group of stocks that you want to compare it to instead of the market to determine a beta. And in Mr. Walters' application of that Vasicek adjustment, he comes up with betas that are substantially lower than those that are produced using the more conventional methods. So I'm not aware, again, of a regulator that has adopted this approach. I know Mr. Walters, it's something that he likes to use, but I don't think it's a primary method in my experience for these purposes or a reliable one.
Okay, so back to my question, which is when you make adjustments to his CAP-M, you only exclude the Kroll method. You don't make adjustments on the various types of beta he used.
That's right, because it was a bigger, and I was just trying to illustrate the bigger point around the Kroll equity risk premium.
Okay, thank you. And that answers the question then. Okay, last question for you. So you corrected or you adjusted Mr. Walters' RPM outputs. And I believe the as adjusted by or corrected by you ranged from 10.14 to 10.39%. Is that ringing a bell?
It is, and in my corrected exhibit, it's 10.08 to 10.39 in my corrected table.
So which of those two outputs, 10.14, 10.39, is more reliable, or should this commission consider the range?
Well, as applied to Mr. Walters' data, the 10.08 to 10.39 range, I think is probably the more reliable way to interpret
Okay.
what I have done there.
Okay. Okay.
And as I recall, that was based on two different bond yields, utility bond yields versus treasury bond yields. So I think I would take the range as being indicative from my version of Mr. Walters' work.
Okay, that answers my question. Thank you very much. I have nothing further. Thank you for your responses.
Okay, it's time for the morning break to allow the court reporter to have rest her fingers for a bit. Let's come back on the record at 11:35. the record. Okay, any other commissioner questions? Okay, questions on commission questions?
If I may, Commissioner.
Yes, go ahead, Mr. Freeman.
Does FERC use the sustainable DCF model?
No, it uses what's called a two-stage DCF, where it's 80%. On the DCF side, it's 80% based on short-term for an electric utility, 80% based on analyst growth rates, and 20% based on GDP, and it weights them together.
I understand. I don't,
It used to use it, but it no longer does.
the GDP is still a factor within it, though. That's my memory.
20% and versus 80% for analyst growth rates, and then it runs it as a constant growth model over for perpetuity.
Thank you. I don't have any more questions.
Welcome. Yeah.
Oh,
Commissioner Duffley?
actually, we have a commissioner question. Commissioner Kimmerite?
Following up on your response, you said that FERC used to use the sustainable growth rate. When did it stop doing so?
I don't know the answer to that. FERC has gone in and out of its methodologies many times over the years. It has accepted various methodologies over time, and then it seems like they're continuously appealed, then it goes back to rethink them. I cannot think of a time where it has used them as a primary method in my experience before FERC. What it has done is it's altered the weight that it's placed on other models like the risk premium model. It's always used the DCF. In recent years, it's added the risk premium model and the Cap-M, and it averages those. And the DCF version that I just described is the one that's weighted by 80% analyst, 20% GDP. That used to be 66%, but it's increased the weight associated with analyst growth rates in its most recent iteration, in addition to the Cap-M and the risk premium, and it takes the average of those three. Under its recent appeal, it may be that it's only using two models, which would be the Cap-M and the DCF, and it would average those two. It's kind of the state of the art before FERC right now.
Okay, Mr. Freeman, do you have any follow-up questions on Commissioner Kimmerite's question?
I do not. Thank you, though.
Mr. Mehta?
Thank you, Commissioner Duffley. Mr. Coyne, if you would pull back out DEC potential redirect exhibit 26. And Commissioner Duffley, if we could mark that as DEC Coyne rebuttal redirect exhibit 1.
It shall be so marked.
And Mr. Coyne, when you were discussing this exhibit with Chair Mitchell, you drew her attention in response to her question to the immediate past rate case for DEC. If you look at the table as a whole, first of all, Concentric put together this exhibit, correct?
That's right.
Okay. What were you trying to convey in the exhibit as a whole?
Well, two things that to draw attention to the fact that as we estimate statistically at a more intuitive level, when interest rates have been higher in the past, the levels that are similar to what we see today, then the commission has awarded ROEs similar to those that are requested in this case. So for example, if you go back to the 2011 case where the commission awarded a 10.5% ROE, 30-year treasury yields were between 3 and 4.24%, and today they're at 4.29%. So it's for those of us that do this work all the time, it's 2011 sounds like a long time ago, but it's really not that long ago that we had interest rates that look like those that we have today. So it's just a reminder that there has been a relationship between interest rates and the cost of capital has increased across the board as reflected in treasury yields for the government, as reflected in A and BAA rated utility bonds. So it's not surprising that the models used to calculate the cost of capital would produce a result that's higher than it's been in the recent past, corresponding to the across-the-board increases in the cost of all forms of capital. Everything from mortgages to short-term government bond yields have increased. The reason that we put the table together this way is that Mr. Walters in prior testimony used this same table, and this was in an Ameren, Missouri case, as I recall, to make a reciprocal argument that because interest rates had gone down, that the commission should award a lower ROE than it had done previously. And I think that argument holds here, but again, reciprocally, interest rates are higher now. And as a result of that, it's appropriate to consider that the models would produce a higher ROE result.
Mr. Coyne, just one last set of questions. On page 8 of your rebuttal testimony, you have a figure 1. And you mentioned just a few minutes ago that the 30-year Treasury yields, as well as the A-rated and B-rated utility bonds interest rates, had risen since the company's prior rate case. Is that what this table shows?
It does. And the reason we talk about both treasuries as well as utility bond yields is because the utility bond yields are a more direct indicator of the cost of capital for utilities because it's specific to their risks. Even though it doesn't tell us precisely what the cost of equity has done, it's an indicator of the investor sentiment regarding required costs of capital for the utility sector. And since the commission's last order, and that was on 3/31/21, 30-year Treasury yields have gone up by 1.61% in that period of time. And this was as of the end of July. They're higher today. And Moody's A-rated utility bonds have gone up more by 2%, and the same with the BAA bonds. So what this has shown, and I think this is consistent with what Mr. Newland described, that the cost of capital has come up in the market for utilities, just as it has for the government, but in excess of 2%. And so thinking about the commission's last award of 9.6%, a 10.4% request, as we see today, is only up by 80 basis points, as opposed to treasury yields and bond yields that have gone up by much more than that. You typically don't expect them to go up on a one-to-one basis, but this is less than half the increase in interest rates as reflected in that difference in what was awarded and the request of 10.4% in this case.
Nothing further, Commissioner Duffley.
Okay, thank you, Mr. Coyne. We appreciate your testimony today, and you may step down and be excused.
Thank you very much.
Commissioner Duffley, DEC would move into evidence. Mr. Coyne's rebuttal exhibits with Exhibit 2 being corrected, and also DEC Coyne rebuttal redirect Exhibit 1.
Without objection, that motion is allowed.
Thank you.
Mr. Freeman?
Thank you, Commissioner. I apologize.
Mr. Freeman, would you like to move in public staff Coyne rebuttal cross exhibits 1 and 2 into the record?
Thank you very much, Commissioner. I would.
Without objection, that motion is allowed.
Commissioner Duffley, At this time, DEC calls to the witness stand on rebuttal, the witness panel of Laura Bateman, Melissa Abernathy, and Phil Stillman.
Good morning. It's still morning. If you could, place your left hand on the Bible, raise your right. Do you solemnly swear that the testimony you will provide today will be the truth, the whole truth, and nothing but the truth, so help you God?
Good afternoon, Commissioner Duffley, Mindy McGrath, law firm of Troutman Pepper, appearing on behalf of Duke Energy Carolinas. Ms. Abernathy, we'll start with you. Can you please state your name and business address for the record?
Sure. Melissa Abernathy, 525 South Tryon Street, Charlotte, North Carolina.
And by whom are you employed and in what capacity?
Duke Energy Carolinas as a Director of Rates and Regulatory Planning.
And on August 4th, 2023, did you cause to be pre-filed rebuttal testimony consisting of 28 pages and one exhibit marked Abernathy Rebuttal Exhibit Number 1?
I did.
And on August 24th, 2023, did you file corrections to your rebuttal testimony?
Yes.
Aside from the corrections made in your errata filing, do you have any other corrections to your pre-filed rebuttal testimony or exhibit?
No, I do not.
And if I asked you the same questions today that are set forth in your pre-filed rebuttal testimony while you are under oath, would your answers be the same?
Yes, they would.
Commissioner Duffley, at this time, the company would ask that Ms. Abernathy's pre-filed rebuttal testimony be entered into the record as if given orally from the stand, and that her rebuttal exhibit be marked as when pre-filed.
The rebuttal testimony of witness Abernathy filed on August 4th, 2023, consisting of 28 pages, and as corrected on August 24th, 2023, will be copied into the record as if given orally from the stand. The exhibit will be marked for identification as pre-filed.
Thank you. And Ms. Abernathy, on August 24th, 2023, did you prepare and cause to be filed a summary of your rebuttal testimony?
Yes, I did.
And Commissioner Duffley, at this time, the company would ask that the summary be copied into the record as if given orally from the stand.
The summary will be copied into the record as if given orally from the stand.
Thank you. Ms. Bateman, can you please state your name and business address for the record?
Yes, my name is Laura Bateman and my business address is 411 Fayetteville Street, Raleigh, North Carolina.
And by whom are you employed and in what capacity?
I'm employed by Duke Energy Carolinas as Vice President of Rates and Regulatory Strategy for the Carolinas.
And Mr. Stillman, can you please state your name and business address for the record?
Yes, my name is Philip Stillman and the business address is 525 South Tryon Street, Charlotte, North Carolina.
And by whom are you employed and in what capacity?
I am employed by Duke Energy Business Services and I'm the Managing Director of Load Forecasting and Corporate Strategic Regulatory Initiatives.
Ms. Bateman, on August 4th, 2023, did the PBR policy panel cause to be pre-filed in this docket rebuttal testimony consisting of 64 pages and 2 exhibits marked PBR policy panel rebuttal exhibits 1 and 2?
Yes.
And was the PBR policy panel's rebuttal testimony and the exhibits prepared by the panel or under the panel's supervision?
Yes.
And does the panel have any corrections to PBR policy panel, the pre-filed rebuttal testimony or the exhibits?
No.
And if I ask the panel the same questions that are set forth in the pre-filed rebuttal testimony while you're while you are on the stand under oath today, would your answers be the same?
Yes, they would.
And Mr. Stillman, if I asked you the same answers that are set forth in your pre-filed rebuttal testimony, would your answers be the same?
Yes, they would.
Commissioner Duffley, at this time, the company would ask that the PBR policy panel's pre-filed rebuttal testimony be entered into the record as if given orally from the stand, and that the accompanying exhibits be marked as pre-filed.
The rebuttal testimony of the PBR policy panel consisting of witness Bateman and witness Stillman filed on August 4th, 2023, consisting of 64 pages, will be copied into the record as if given orally from the stand. The 2 exhibits will be marked for identification as pre-filed.
Thank you. And lastly, Ms. Bateman, did the PBR policy panel prepare a summary of its rebuttal testimony that was pre-filed in this docket on August 24th, 2023?
Yes.
Commissioner Duffy, at this time, I would ask that the summary of the pre-filed rebuttal testimony be entered into the record as if given orally.
The summary will be entered into the record as if given orally from the stand.
Thank you. The witnesses are available for cross and commissioner questions.
Mr. Tratham?
Yes, thank you, Commissioner Duffley. Panel, I'm Marcus Tratham. I represent CUCA. Ms. Abernathy, I believe my questions are directed at you. Just have a few. Really, they're in the nature of house cleaning with respect to your direct testimony. Since you did not testify on direct, your counsel had agreed that I could ask a few questions relating to your direct testimony. With respect to your exhibits 1 and 2 that were attached to your direct testimony, those exhibits seek to inventory the proposed cost for the multi-year investments, correct?
Yes, Exhibit 1 lists out the multi-year rate plan projects, and then Exhibit 2 gives more details on those projects. So for certain functions, it breaks it out into specific locations, the timing of the projects, the functionalization of the projects, basically all the different details I needed to calculate the revenue requirement.
Okay, and you took the cost information that was provided by the operations witnesses and combined that on the exhibits, correct?
Yes, each of the operational witnesses provided me the information into here, and then we calculated the North Carolina retail portion that's shown on Exhibit 2.
And I assume you didn't audit the cost information that was provided. You just accepted it as valid and correct and input it into your exhibits. Is that right?
That's right. I took the information from the operational witnesses who are supporting the projects that they plan to perform over the multi-year rate plan period.
And as to the specifics of what those expenses are for, am I correct that you would defer to those operational witnesses as they've described the projects?
Yes, from an operational standpoint, they support the need for those projects.
Okay. And by your testimony, you aren't offering an opinion as to whether a specific project meets the legal requirements under GS 62-133.16 for inclusion in the multi-year rate plan, are you?
I do believe the information we've provided is consistent with the statute and then the rule to implement that statute.
Okay, and you're not a lawyer, are you?
I am not.
Okay. And so what basis are you making any legal conclusions with respect to the eligibility for treatment under the statute?
I'm not making a legal conclusion, but I do feel that the information we've provided is consistent with the rules and statute.
Okay. And could you just sort of highlight the difference between Exhibit 1 and Exhibit 2?
Sure. Exhibit 1 lists the multi-year rate plan projects. It gives the name of the project, the function, the operation, so you can tie it to the witness exhibits there, as well as the in-service date and then the total system cost. Exhibit 2 gives a little bit more project details related to the projects. The biggest difference will be on the T&D projects listed. Those are broken out into more specifics around the specific locations where the work will be done, as well as the timing, so that we could understand how they will be performed across the multi-year rate plan period. Occasionally, some of the projects are split out on Exhibit 2 as well to split out the functionalization of the assets. So for example, the solar facilities had a portion that's a generation asset and then a portion that may have impacted the T or D system. So we had to show that split on Exhibit 2 as well so that we could do the proper North Carolina retail allocation per cost of service. So then Exhibit 2 additionally then shows the North Carolina retail amount of each of the projects. I think that's the most significant difference there, other than just more detail on the projects.
Okay. And how many total projects are included in the multi-year proposal over the life of the plan?
So I think if you look at my exhibits supporting my supplemental settlement testimony, it's probably the latest version. Exhibit 1, I believe, has around 350 MYRP projects. Let me get to that. 349 MYRP projects on Exhibit 1, and then Exhibit 2 breaks that out into further details. It ends up getting broken out into 1,355 lines on that exhibit to show all the details over the MYRP period.
Okay. So you're looking at your supplemental testimony?
Yes.
Okay. And so you've given me two numbers. One is 349 and the other, I didn't capture it, but it was 1,300-ish.
Yeah, and I should clarify, I'm looking at my supplemental settlement exhibits.
Thank you. And so is it fair to say that looked at the most granular level that there are some 1,300 projects that Duke is seeking to include in the multi-year plan?
We have it broken out into 1,300 project detail lines in order to do the calculation. But I think you could approximate, it's going to be somewhat less than that. Some of the projects will have multiple lines because they go in service over multiple periods. But from Exhibit 1, we have about 350 MYRP projects that we're proposing.
Okay, which is it? That's a big difference between the two of them. Is it 350 projects or is it 1,300 projects?
I would use Exhibit 1 to quantify our number of projects. And that's 349 projects on MYRP.
Okay, all right. And do you understand that under the multi-year statute that we're applying in this case, that the capital investments to be included in the plan are to be net of operating benefits, including operation and maintenance savings?
Yes.
And have you, can I look at, I didn't actually see that number anywhere in your exhibits, but I may have missed it. Have you quantified what those savings are, and can I see that number on your exhibits?
So within Exhibit 1, there's a couple columns that have the dollar values, and the first is the projected in-service capital amount. The second is the projected annual net O&M. So that column would include any incremental O&M as well as any incremental O&M savings associated with those projects.
You're saying that the savings are netted out from that number?
Yes, what I presented here is a net O&M number. So it's net, it's the incremental cost as well as the incremental savings net together.
Okay, what I'm asking for is the actual amount of the savings which were netted out. What's that number?
I don't have that here. I just have the net number that's shown on our exhibit.
Okay, all right. And okay. That's all I have. Thank you.
Okay. Mr. Blumenthal?
Thank you, Commissioner Duffley. Ethan Blumenthal on behalf of NCSEA. I believe my questions will be mostly for Ms. Bateman here. Looking at page 21 of your rebuttal testimony,
Yes.
Yeah. Starting on line 6, you testify that Dr. Kaufman's proposal has no basis in House Bill 951's language authorizing securitization of the remaining net book value early of retired subcritical coal generating facilities. Furthermore, it would be inappropriate to have current customers who are benefiting from coal plant generation not pay any of the costs of that generation. That correct?
Yes.
Do you understand Dr. Kaufman's proposal for securitization of coal assets to be for DEC to, quote, defer 50% of DEC's return on rate base associated with subcritical coal-fired electric generating facilities to be retired early, and to defer 50% of depreciation expenses associated with these plants?
Yes, and so there would be no recovery for 50% of the plant. And I think that is an extreme proposal to propose no recovery from current ratepayers for 50% of the plant. It's not consistent with the language of HB 951, which proposes that we're eligible to securitize 50% of the net book value upon retirement. And also when I asked in a data request if Dr. Kaufman could provide any other jurisdiction that had done this, he couldn't. And so, because I'm always open, this seems like an extreme proposal, but if there's some model that we could follow, I could look at that. But I think it's extremely problematic, especially when you start to defer return on your operating coal plant. I think there's some regulatory accounting issues with that would make it just not feasible.
Thank you. So does Dr. Kaufman's proposal include deferral of any operations and maintenance expenses associated with operating coal plants?
I did not see that.
So under the understanding that his proposal is to defer 50% of the return on rate base and 50% of the depreciation expenses and doesn't address O&M expenses, when you represent that current customers will not pay any of the costs of that generation, that's not quite correct, is it?
No, I would still stand by that. And what I meant was for those coal plants, for the recovery of the plant, the return on and of that coal plant, for 50% of it, there would be no recovery from current customers.
And you testified that Dr. Kaufman was not able to provide any examples where this has been done in responding to a discovery request, correct?
Yes.
At this time, I'd like to introduce a cross-examination exhibit. May I approach to give the appropriate binder?
You may.
Looking at NCSEA potential cross exhibit 6, I propose to have that marked NCSEA Bateman, Stillman, Abernathy rebuttal cross exhibit 1.
It shall be the exhibit, potential exhibit 6 shall be marked as NCSEA Bateman, Stillman, and Abernathy rebuttal cross exhibit number 1.
Is this discovery request you previously referenced?
Yes.
And the request for this reads, please identify utilities that are permitted to securitize a coal plant's net book value prior to retirement or have stopped recovery on a coal plant while it was still operational in order to inflate the net book value at retirement that could be securitized, correct?
Correct.
So again, based on the understanding of Dr. Kaufman's proposal that we've just gone through, the 50% of return on rate base, 50% of depreciation expenses and O&M expenses excluded, this request would not directly address that proposal, does it?
Well, I think it does because it's stopping recovery on 50% of the coal plant. And so the response is that there was nothing. And in addition, during the NERP process, we had experts come in and speak to us about securitization of the net book value of coal plants. We spent a year studying this. And in none of those presentations did I see an example like what witness Kaufman is proposing. And so I don't think there is an example of it. One, because of the issues that I think there would be with regulatory accounting. But I think it would be extremely problematic. And in all of that study, I did not see one example of a company that's done something similar to what he's proposing. And Mr. Kaufman couldn't provide an example either.
I'd like to go back to your statement that Dr. Kaufman's proposal has no basis in 951's language. I believe that the commission has already taken judicial notice of House Bill 951 previously in this proceeding. We have that provided under tab number 8 in the first binder there. And then looking at part 3, section 5, which is on page 9 of the bill. Yes, I believe the relevant provision regarding securitization reads, with respect to securitization of costs associated with early retirement of subcritical coal electric generating facilities, the commission shall develop rules to determine costs to be securitized at 50% of the remaining net book value of all subcritical coal-fired electric generating facilities to be retired to achieve the authorized carbon reduction goals set forth in section 1 of this act, with any remaining non-securitized costs to be recovered through rates. Rules, procedures, obligations, and protections adopted for securitization of costs associated with retirement of subcritical coal-fired generating facilities shall be substantively identical to the provisions of Section 1 of State Law 2019-244, except with respect to the purposes for which securitization may be used under that section. That all, I believe I got it correct, Maeve.
Yes.
Thank you. And that is the entirety of the substantive language regarding securitization within House Bill 951, correct?
I believe that is correct.
Would you agree that to be retired and actually retired are not the same thing?
I would agree with that, but I think, let me just get to that section because I think you need to, I think the to be retired needs to go with to achieve the authorized carbon reduction goals. So these plants are being retired to achieve the authorized reduction goals set forth in this act.
Okay. I'd like to ask for the commission to take judicial notice of its order adopting Rule R8-74 issued on April 5th of 2022 and docket E100 sub 177.
The commission will take judicial notice.
Thank you. That is behind tab 9 for you. And are you familiar with this order and or Rule R8-74?
Yes.
On page 7 of that order, towards the bottom of the first paragraph, I believe there is a sentence that states the commission finds that it is preferable for Rule R8-74 to be less prescriptive in order to allow the parties in the commission flexibility and to address changing conditions as they arise.
Where are you?
Yeah, page 7, it would be towards the bottom of that first paragraph.
Yes.
Yep. And then a little later down on page 8, about halfway through that first full paragraph. So the next page there. Yeah, I believe it says Rule R8-74 contains the flexibility necessary to include the provisions that were in the storm cost financing orders, along with other beneficial provisions as the commission finds reasonable and appropriate. However, locking those provisions in at this time may serve to reduce the commission's flexibility in the future. You see that?
Yes, I do. And I would agree with that.
Okay, and so from these quotes, would you agree that it's fair to say the commission was interested in preserving flexibility when it adopted this rule?
I would say flexibility on some things though, and I'm just trying to flip through here because I think we did talk about, whether it was upon retirement or not. And so, I might not be able to find it on the stand here, but obviously the commission knows what they put in their rule. And I think if I can find where it's specifically stated, I will, but otherwise, I think the intent was that upon retirement, that 50% would be eligible for securitization. I think there was some flexibility on exactly how that works because when we retire the plant, there's a benefit to reaching a certain threshold. And so the timing of the securitization, there needs to be flexibility around that, especially as the coal plant retirement dates change. You might want to bundle different net book values together.
Now looking, it's page 2 of the appendix, I think there's only one there, which has the rule itself. Looking at section subsection 8, that is defining coal plant retirement costs, correct?
Yes.
And then subsection A provides 50% of the remaining net book value of all public utilities, all A public utilities, subcritical coal-fired electric generating facilities retired early or to be retired early to achieve the authorized carbon reduction goals set forth in section 1 of House Bill 951 that are appropriate for recovery from existing and future retail customers receiving transmission or distribution service from such public utility. Correct?
Yes, and again, I think it's the to be retired early, that it's specifying the intent of the retirement there. And just to go back to all of the NERP presentations, the expert presentations in that docket, in that collaborative, there was nothing about securitizing or stopping recovery on coal plants while they are still operational. And the whole push for securitization of net book value of early retired coal plants was to provide an incentive or some benefit to actually retiring the coal plant early, not just setting aside money and stopping recovery of it in order to have something to securitize at the end of the plant's life. The whole point is to kind of offset the impact of retiring early when you have a net book value left at retirement. And what the company has proposed in this case, what the company initially proposed really just kept the net book value what it would be if we did not accelerate the retirement dates in the depreciation study. Because if you accelerate the retirement dates and then you set your depreciation rates to recover the net book value by that new accelerated retirement date, theoretically, the net book value at the end of its life would be 0. And so we didn't want to do that. But if you keep those depreciation rates the same or the retirement date in the depreciation rates the same for North Carolina retail rate making purposes, you preserve that net book value to what it would have been had you not changed the retirement date and the depreciation rates. So I know that's a lot, but that was the intent of our proposal. And then, of course, in settlement with the public staff, we increased the 50% to 75%. And that extra 25% isn't part of what would be securitized, but it was an extra 25% that would be recovered in the future through traditional rate making. But that was the intent of what we had proposed, but it was never the thought in any expert presentation that I've seen or in any of those discussions that you would just stop recovery of a return on and of your coal plants while they're still operational.
Thank you for that answer. I'd like to turn back to, or within the law as it addresses Session Law 2019-244 and would ask the commission to take judicial notice of Session Law 2019-244, otherwise known as Senate Bill 559.
The commission will take judicial notice.
Thank you. And couple more here. I'd also ask for the commission to take judicial notice of the DEC financing order issued by this commission on May 10th, 2021 in docket E-7 sub 1243.
The commission will take judicial notice.
And finally, I'd like to introduce another cross-examination exhibit. This one is NCSEA Potential Exhibit 12. And I'd like to propose for it to be marked NCSEA Bateman, Stillman, and Abernathy Rebuttal Cross Exhibit 2.
It shall be so marked.
Thank you. Looking behind page that for the cross exhibit, so that would be tab 12. This is the DEP and DEC joint petitions for financing orders, correct?
Yes, this is for the storm costs.
Yes, yes, for storm recovery. Now looking on page 17 of that in paragraph 27.
I'm sorry, what page were you at?
Page 17. In that paragraph, do you see where DEC is asking to securitize $230.8 million in storm recovery costs?
Yes.
And then further down in that paragraph, there it states, accordingly, DEC proposes to finance its total storm recovery costs through securitization.
Yes.
Next, I'd like to go back to tab 11, which is the commission's financing order.
I will say though that that total was very specific to this docket, the total kind of these particular storms, not all storm costs.
Yes, yes. Yeah, and so tab 11, and then we're looking at page 19.
Yes.
And we're going just two paragraphs up from that break of upfront financing costs. The commission found that DEC's storm recovery costs, subject to public staff review, are eligible for recovery through financing. Correct?
Yes.
So would this be an example of the utility seeking and receiving approval to securitize the full value of a still operating asset, similar to the discovery request that we previously discussed?
Not at all. These are storm costs for storms, storm cost recovery that had been completed several years prior. I think the storms, they were already completed. So it was work that was already done, costs that were already spent, and we were seeking to recover those prior costs. These are not assets that were that ongoing operating generation. I think there's a difference.
Thank you, Commissioner. No further questions.
Okay, thank you. Mr. Magruder?
Good afternoon, Menashe Magruder on behalf of NCJC et al. And Vote Solar. My questions are going to be directed to Ms. Bateman and Mr. Stillman. So if either of you feel comfortable answering those questions, feel free to do so. Okay, so the two of you mentioned on pages 4 through 7 of your rebuttal testimony that you disagree with the intervener witnesses' recommendations that a lower return on equity is warranted if DEC and YRP is approved. Is that right? I'll wait until you get there.
Which page?
These are pages 4 through 7 of your rebuttal testimony.
Yes.
Okay. So we're going to jump to page 5. So specifically, the two of you note page 5 of your rebuttal testimony, starting at line 19, that the conclusion to draw from these statistics is that alternative rate making regulation is the norm. You there?
Yes.
Okay. And this is referring to Duke's nationwide PBR survey and analysis that was included in the NERP final report as Appendix A. Is that right?
So no, it was based on the initial survey that was part of the NERP research, but then it was also, we took a fresh look at that this year, and then I filed the exhibits that I filed were prepared this year based on more current information. It was a combination of some cross exhibits that were introduced in the DEP case, as well as some other industry publications that I looked at.
Can you go to footnote 1 there? It reads C NERP PBR study group work products PBR regulatory guidance Appendix A.
Yes, that was the initial
Okay.
look. So that kind of what I quoted in that paragraph is from the NERP publication, but then the exhibits were more updated.
Okay. Do you have the NCJC exhibit notebook in front of you? If not, I think we've got one on the side table here.
It might be more efficient if you help me find it.
My approach, thanks.
Okay.
Can I have you turn to tab 1?
Yes.
And Ms. Bateman, these are the NERP PBR study work root products, correct?
Yes.
Commissioner Duffley had asked that this exhibit be marked as NCJC et al. Bateman, Stillman, Abernathy, Rebuttal, Cross, Exhibit 1.
It shall be so marked.
Let's turn to Appendix A, which I think is on page 33 of that tab. It should be page 37 of the PDF if you're following along.
Yes.
Right, and that's the sort of the nationwide PBR survey and analysis that was included in the NERP final reports. Is that right?
Yes, this is the research that we did in 2020 as part of the NERP
Okay.
process.
So to be clear, this Appendix A, which is the survey and analysis that was included in the NERP final report, it didn't look at allowed ROEs in states that had alternative rate making and compare those with allowed ROEs in peer states that did not have alternative rate making.
No, it simply looked across the country and found that most states have some form of alternative rate making.
Okay. Let's go back to your rebuttal testimony. Can you turn to page 6 of that testimony?
Yes.
Can you read so it's lines 8 through 10. So the sentence that starts with therefore and then ends, I believe, with risk to the utility.
Yeah, and just the kind of the therefore is following the paragraph that talks about the NERP research that showed that most states have some form of alternative rate making, looking at the proxy group for Witness Walters or Witness Morin, that most of those companies operate in at least one state that has alternative regulation. And then lastly, the kind of more recent survey that we did across the country, looking at states that have one or more form of alternative regulation. So with all of that, that kind of alternative regulation is the norm and it's baked into the proxy group. Therefore, the focus should not be on whether DEC has a multi-year rate plan, but rather on how the North Carolina PBR framework compares to alternative regulation in other states in terms of risk to the utility.
Okay, thank you. Let's turn to, let me just get situated here. Yeah, let's turn to PBR Policy Panel Rebuttal Exhibit 1.
Yes.
Okay, so I think you'd mentioned this earlier in your testimony in the stand, but this is some of the analysis that DEC has conducted with respect to PBR in different states, updating, I guess, Appendix A. Is that right?
Yeah, I would say, I wouldn't use the word PBR, I would say alternative rate making.
Sure.
And I specifically list the forms of alternative rate making, but they were similar to the ones that we looked at in the NERC research.
Okay.
So formula rates, multi-year rate plans, including PBRs with multi-year rate plans, future test years, and then trackers for grid or other capital investments, as well as decoupling.
Okay. So I've reviewed this exhibit. I've also reviewed PBR Policy Panel Rebuttal Exhibit 2, which, feel free to go there just to review that briefly. I don't think either of these tables specify whether a peer utility or a peer state would allow a utility to file a general rate case if they under-earn during the multi-year rate plan term, does it?
No, I don't have that information in here, but I will address that because I think people have brought that up. Several interveners have tried to make that a big point, as this just reduces the company's risk. But if you think about the time frame from when you file a multi-year rate plan to when you get rates effective, we're talking, I think it's almost 16 months. And so the utility has to under-earn for 16 months. There's no clawback like there is for the earnings sharing mechanism. So that's a significant risk to the utility. It's kind of a backstop. We talked a lot about in the NERC process, like exit ramps. If you've designed something wrong, if something goes very afoul, I would put this in that category, that there's an exit ramp if something goes wrong. I think there's a symmetrical exit ramp, though, if in that the commission can also, for good cause, initiate a proceeding either on their own choosing or a motion from the public staff can also initiate a proceeding to change rates or PIMs. So I view it as symmetrical. If the ROE goes below a certain level, the company can initiate a rate case. If for any good reason, if something's going wrong, the commission or the public staff can also initiate a proceeding.
And again, not to bear too fine a point on this, I'm just kind of going back to your rebuttal testimony here. Ultimately, the focus when we're thinking about ROE and MYRP and the risk is, I'm going to directly quote from the two of you here, how the North Carolina PBR framework compares to alternative regulation in other states in terms of risk to the utility.
Yes.
Okay. So if you have two utilities in two jurisdictions that have pretty much identical PBR statutes, the sole exception being that one utility can file a general rate case during the MYRP term and the other cannot, would you agree that the utility that can file a general rate case during the MYRP term has less risk?
No, I would not. I see that as a very, very small, kind of the exception to the rule. Like I said, this is I don't expect either of those of the symmetrical side to happen. I don't think that will be the norm. But if we get something wrong, if something goes horribly wrong, and either the company isn't going to come close to earning its allowed return, or something else is wrong. I was going to say if we over earn, there can be a refund through the earnings sharing mechanism. But if there's something else that is just off, this commission can also open a proceeding. So I view that as kind of the extreme tail ends of what I would expect to happen.
Okay. Turn to page 49 of your rebuttal testimony, and I'll wait till y'all get there.
Yes.
Okay. You mentioned that the proposed fuel cost PIM that NCJC et al. And Vote Solar have proposed is flawed because, paraphrasing, it implies that keeping customer fuel costs is not aligned with company interests.
Yes, that's what we say there. And we give many examples of the steps that the company has taken to minimize fuel costs, which align really with most of the recommendations that, that your witness put in her testimony.
Okay. The company has proposed a reliability PIM, correct?
Say that one more time.
The company has proposed a reliability PIM.
Yes.
You would agree that promoting reliability is aligned with the company's interests?
Yes.
Okay. And I think you already started forecasting this a little bit. You note several of the programs that DEC has implemented to reduce fuel costs. I'm not going to go through all of them. There's a fair amount, but just for illustrative purposes, the company's hedging program, joint dispatch agreement, the one face to the market strategy, other strategies.
Many others, yes.
Okay. Company's proud of the savings these programs have delivered, correct?
Very proud of that.
Okay. Would you agree then that the success of these strategies and the resources Duke has dedicated to these strategies demonstrates that Duke has some control over its fuel costs?
So some control, and the strategies that we put in place here would show that. So we've taken the actions to try to minimize costs to any extent that we can. But I think the difference here, or one thing that that I pointed out in this testimony also, is that we've got a very robust fuel clause. That once a year, the costs are that they go through an audit process, let's call it. So those costs are reviewed very thoroughly, and if any costs were found to be imprudent, then they would be excluded from collection.
Okay.
Mr. Stillman, when you're answering, if you could please pull the microphone a bit closer. Thank you.
Let's turn to the bottom of page 60 of your rebuttal testimony.
Yes.
Okay. You note there that the two of you oppose this PIM, and this is specifically NCJC et al. And Vote Solar's IRA PIM, because it would, quote, assess DEC a penalty equal to the amount of unleveraged savings offered by the IRA. Is that right?
Are you reading from a particular line?
Yeah, I can give you the line number, just one sec. So this is line, starts, I guess, 17, 18 on page 60.
Yes.
Okay. Do you have NCJC et al. And Vote Solar pre-filed testimony from Janelle Wilson in front of you? May I approach?
You may.
Okay, so I've handed you and I've handed council page 54 of NCJC et al. And Vote Solar pre-filed testimony from Janelle Wilson. Can I have either of you, I guess Ms. Bateman, could you read lines 11 through 13 of Ms. Wilson's testimony out loud? It's, I guess, the passage that starts with a PIM and it ends with programs and provisions.
A PIM could be designed to incentivize the utility to capture adders specifically, or it could be designed more broadly to reflect other IRA and IIJA programs and provisions.
Okay, so to paraphrase, basically this, our proposal is sort of an either or proposition. You could have a more narrow PIM that's just about adders, or you could have a broader PIM that is sort of all the potential saving opportunities you could get under the IRA.
So I think that's what it says here. So it's not very well defined as to what this PIM would look like. And I know that we've heard testimony from the company, from Witness Klein and Witness Beneza, that identified a lot of the uncertainty that are still there with the IIJA and with the IRA, and the levels of collection that the company will have. And I also know in testimony here, Ms. Abernathy's talked about the intent of the company to flow back all of the proceeds that the company is able to receive from the IIJA and IRA once we actually have programs up and running where we can collect those monies and refund them to the customer. So I think what we're trying to say here, one reason that we thought that this PIM really didn't fit in the proceeding that we're talking about here is the level of uncertainty and how you would measure that. You know, if you're going to have a PIM, there has to be a very defined way to measure it. And under NERP, you know, you want that, NERP specifically says you want that definition and the calculation to be easily identifiable, easily auditable. And right now, at least the status of what IIJA and IRA are, we're not near that step yet.
Okay, thank you. Just give me 1 sec because I have the page number, but I don't have the line number. So I want to make sure that I get that to you. So in the meantime, can you turn to page 61 of your rebuttal testimony?
Yes.
Okay, so this is lines 2 through 5. You mentioned, and I'm paraphrasing here, that, and this is another argument that y'all lodge in opposition to our IRA PIM. You note, again, paraphrasing, that the company already has an incentive to pursue IRA or other tax incentives because of the risk of, I believe, disallowance. Is that right? This is lines 2 through 4 or 5 of page 61.
Yes, so that first paragraph on page 61, it does mention that through the audit process, there's always the risk of disallowance. And I think there was some mention of that in some testimony in this case. So there's always that, but I would also go back, and we just talked about the fuel PIM as well as this. The company always has an incentive to maintain or to reduce costs as much as it can. And I think this falls into that category.
With respect to this argument about the risk of disallowance, the company has proposed a reliability PIM. Is that right?
So I'm not drawing how you're trying to connect the reliability PIM to a disallowance.
I will draw it right here. So is it your position that the company faces no risk of disallowance if its investments, for example, fail to achieve certain objectives with respect to reliability?
Could you give an example? I'm thinking of our reliability PIM that is based on a SAIDI metric of the duration of outages. So
the reliability PIM at a, I guess, high level is being implemented to promote, maintain certain reliability indicia. If you had certain grid investments that were proposed for inclusion, that's, I guess, either at a higher level or maybe at a more granular level, are tied to one of these indicia. If it came to pass that this grid investment, either through testimony that's elicited at the hearing or otherwise, it became clear that they weren't actually helping to improve SAIDI or safety, is it your position that there would be no risk of disallowance there?
So I think the programs that are in place for the multi-year rate plan and all of the different distribution categories, reliability is one of them. Reliability was actually a metric that in our stakeholder process was brought up, and some of the stakeholders requested that that be one of the PIMs, and we agree with that because we definitely want to provide a service territory that's very reliable. We want to make sure that that safeguard is in place. But when you look at the 349 projects that Witness Abernathy just talked about, reliability is one benefit of those. There's a lot of benefits to those, to kind of stabilizing the grid. Stabilizing the grid, allowing for interconnection of renewables, et cetera, et cetera. So I can't say definitely that if one program did not produce some level of reliability, would that be disallowed? I can't say that.
I would also just like to add that it seems very speculative and hypothetical. The company's been making investments in the grid for a long time now, and I can't remember where there was an allegation that a grid investment was imprudent because of reliability levels. And I'll just ask Mr. Stillman, he's been in the regulatory world quite a while. If I mean, he can add if he remembers one, but I can't. And
no, I was just going to agree, which I think is why I was having difficulty
Yeah.
drawing the line between the disallowance and the reliability PIM.
Yeah, but with the IIJA, we have an example in this very proceeding. So to me, one is kind of maybe more theoretical, and one we have an actual example of.
No further questions.
Redirect.
Nothing from the company.
Okay, Commissioner questions? So I have a few staff questions and they will be directed to Ms. Abernathy. And it's with respect to your supplemental settlement testimony. And really exhibits 2 and 4.
Okay.
So in exhibit 2, on page 68, line 1356, you have a line described as documentation settlement adjustment, where the projected in-service costs for NC retail are reduced by roughly 236 million. Is this adjustment, and so here's their question, is this adjustment applied to specific MYRP projects?
No, it is not. This was part of our settlement agreement with the public staff, and we agreed to reduce the system level and then the North Carolina retail level of capital, but it has not been applied at a project by project basis.
Okay, thank you for that clarification. And then the other question that they had is looking at a toggle between Exhibit 4 and Exhibit 2. There's a summary schedule, or is there a summary schedule that reconciles the 13-month average, the 3.7 billion amount on Exhibit 4? And so that's line 10, column 3, to the 4.6 billion on Exhibit 2, which is the totals with settlement adjustments.
I don't have something here. I think there is something within our work papers. We have a capital summary tab and an O&M summary tab, but the rate-based numbers shown on Exhibit 4 are done at a 13-month average basis, and Exhibit 2 is just the total capital. So
could you provide a reconciliation schedule of
Sure,
late
we can
filed
put something
exhibit for
together.
them? Thank you. And those are all of my questions. Commissioner Hughes.
Yeah, I'm not sure. Were you here when we had the discussion about David Williamson's library? And now, okay.
Yes.
So actually, I think we were talking about performance metrics. But no, joking aside, we were talking about this world of metrics and how from what we, what I can tell, a lot of focus and energy and debate in the PIMs, less so in the tracking mechanism world. Public staff, has some testimony where they sing praises of having more tracking mechanisms, but they do mention the cost of them and concern. So when the smoke cleared, I think the settlement put together a pretty modest level of just metrics, and both tracking metrics and PIMs, as far as just sheer numbers. To me, I went back and tried to look at what the sort of promise was that all of us working collectively were going to try to get out of the application, and the outcomes of this, to just link it to the measures. And there's a number of places in testimony where you could argue that it sort of has the goal statement. I didn't find one goal statement. So the best I could do, and I know this isn't your testimony, but I think it reflects a lot of what you've been talking about, is the witness Bowman is asked, please describe the major drivers behind the company's application. And I don't know if you recall that part of her testimony. I mean, if you want to look at it, it's page 14 on Bowman Direct. But it's just a summary of, again, sort of objectives, goals, what the company's trying to do. There's a major, I'm not gonna read a lot of it, but there's a major heading that says a balanced transition to cleaner energy, and some goals and some ideas of what's in this. There's operational excellence and reliability. Some discussions about that. From what I can tell, both, everything from cyber, but also a lot of the reliance and reliability investments that the company's going to make. Then there's the next one is enhancing the customer experience. Talked a lot about that. And then the last one is customer affordability. So 4 of them. And there's, descriptions, and a lot of what is in this very first testimony has been in everybody else's testimony, both measures and their investments. This list seems pretty impressive. I think it's what a lot of customers would expect. If I'm a customer and go to the performance measurement page, not understanding all the settlements and not understanding kind of everything that happens, and we see, okay, this is the performance measures that Duke is shooting for. This is what they're telling us is important to them. Where do they go? Are each of these represented? By my count, most of them are, but there's one big glaring gap that's represented in these four categories, where I just didn't see any measures, tracking, or PIMs on that page. And it's customer affordability. I mean, maybe I'm wrong, but there's others almost by name and by text in this kind of marching orders. There's something that someone could point to. We have a lot of debates about whether it's the right one or not, but there's at least some performance measure that is being transparently tracked and presented. So my question, sorry for the really long question, but question is that a good thing? Isn't it possible that we could have come up with something related to tracking out? I mean, there's some exciting programs in here, in the case about customer affordability, but they didn't make it into the performance metrics. And is there room for a few more metrics, a few more tracking metrics that kind of fleshed out some of these? It's a big concern because of what we're hearing from customers.
No, I hear you and I understand. And I think coming out of the Duke Energy progress case, there were 2 additional metrics that were added that did touch on the affordability. So it's the number of disconnects and the percentage of an average bill compared to the federal poverty level for a family of four. And I think those were fantastic additions. As we put these together, so think about our original filing. We had what I'll call, and I'm going to use PIMs and metrics to be synonymous here. So forget whether there's a reward or not, just what are we measuring ourselves by? And in that original filing, we had a total of 9 individual metrics. And I count that up because under the renewable and integration PIM, there were 3 different subcomponents. So if I add all those up, those are 9 different metrics that we're measuring ourselves by. And what we wanted to do in this process is to be very responsive to the policy goals that are in the statute. And we tried to touch on all of them, and affordability is one of them right there. Cost savings is one of them, which I think affordability and cost savings are interrelated, maybe not exactly the same thing, but they're related. So as you go through our portfolio, you can see that we feel strongly that I'll still call it the time of use, but the longer name, the time differentiated PIM that has cost savings associated with it. If you think back to our original filing, we had the low income that we in settlement with some parties pulled that out and made that a donation to Share the Light and to the Health and Safety Fund. And I think that is a huge win for affordability. That's going to do a lot of good in addressing some of the concerns that some low-income individuals cannot get some of the energy efficiency programs that we offer because they need to remediate some of the problems in the house. So that helping, or I don't want to call it the Helping House Fund, but funding those, I think goes a long way towards affordability. So again, as we were looking at this portfolio of 9 PIMs and coming out of the Duke Energy Progress case, there's 10 in total. We kind of thought that addressed most of the policy goals. I think the one policy goal that maybe didn't really address was the DSMEE, and we didn't put that in there intentionally because we know that's handled completely separately. But we wanted to address or have something that pointed to each one of those policy goals in one way or another. And typically we referred back to the NERP process to look at what the most preferred metrics were. And we also, through the stakeholder process, tried to get the input from the many stakeholders that we spoke to in the summer of last year during our 2 stakeholder meetings to see what was important to them and what could we include. And of those 9 metrics or PIMs that we initially introduced, 2 of those came straight out of that process. So I understand what you're saying, that maybe you can't look at one and say this is where affordability is. As we were designing those PIMs and looking at cost savings, we were very focused on what are the activities that the company can undertake to achieve the policy goal that's in front of us, as opposed to saying, let's have an affordability PIM. That's why we stepped back and said, okay, let's look at time of use. Let's look at other things where there's cost savings or where we can actually influence to achieve the result that we're looking for. So I hope that's helpful.
It's really helpful. It's what I was hoping. It's just the connection to the policy goals, and there is a connection to the activities. It's just this sort of front page, which or maybe the customers will go way into this rate case order and read through all of the great the great things that are in it, but we'll see. But this performance is like it's the title of what we're doing, performance-based rate making, and it's measures and tracks. So as long as you're aware of that, and I'm hearing that if there were some other maybe not debated measures that I know caused a lot of debate, but if some sort of basic tracking mechanisms that the commission felt, just added to what you're already doing, that's not necessarily a bad thing. Right. Well, thank you very much.
Questions on commission questions? Mr. Tratham?
Yes, thank you. Just following up on Commissioner Yu's question about affordability. Affordability is also critically important to industrial customers, as we've been talking about in this proceeding. CFCA's witness, Mr. Pollock, proposed a very detailed PIM on rate competitiveness, which is how industrial customers look at the issue. Aside from the issue of whether or not there is a penalty, isn't rate competitiveness a metric that we should be tracking as a result of this proceeding?
I hear what you're saying, and rate competitiveness is extremely important. And as I go back to, I believe your witness pulled a lot of that information out of the EEI average bill, typical bill report. And, you know, we went to that report to start to look at this, and, you know, whether we're talking about upside, downside is neither here nor there on this, but as you look at this, there's part of that report shows what the average rate is for the 155 to 160 IOUs that provide information into that report. And for example, if we go to, and this is from the January of this year, so it's a little bit more up to date, I think, than the two reports that was used in the testimony that you just referred to. But if I go to the most current report and I look at that stacking of average rates from best to worst of the 154 companies, Duke Energy Carolina comes in at number 5. So, you know, I'm saying a lot. The commercial is I think in the top 10. The residential rate is in the top 10 also. So we think of rate competitiveness to be crucial. It's very important. And I think what you're seeing in the reports that EEI puts out is that we're delivering on that.
But why not just track it? Why shouldn't that be something that we track as a result of this proceeding? You agree it's important. We've proposed a metric, come back with something. Maybe we can agree on a way to track this. But I mean, it seems like we all agree that it's critically important, but let's track it.
Well, and so then the question comes up, what is the correct way to track it? I don't think that the way that looking at the typical bill, which is, I think, what was in the proposal, there's a couple of idiosyncrasies in using a typical bill. You're not really getting the full impact of what the entirety of the customer base sees. So I think there has to be discussion around what is the proper way to track it, because there's so many different ways to look at this. And it is reported, so that information is available.
Okay, thank you.
No further questions on this side of the room.
None from the company.
Okay, so thank you very much to the panel. We appreciate your testimony here today, and you may step down and you're excused. Motions, Ms. McGrath?
Yes, thank you. I would like to, the company would like to move into the record Abernathy Rebuttal Exhibit Number 1 and PBR Policy Panel Rebuttal Exhibits 1 and 2.
Okay, without objection, that motion is allowed.
Thank you.
NCSEA would like to move into the record NCSEA, Bateman, Stillman, Abernathy, Rebuttal, Cross Exhibits 1 and 2.
Without objection, that motion is allowed.
NCJC et al. And Vote Solar would like to move into the record NCJC et al., Bateman, Stillman, Abernathy, Rebuttal, Cross Exhibit 1.
Without objection, that motion is allowed. Okay, are there any other procedural matters that we need to address at this time?
Yes, Commissioner Duffley. At the close of the company's direct case, we moved in a number of pieces of testimony. There are 2 remaining pieces of pre-filed rebuttal testimony that were not moved at that time. And with your leave, we would now make a motion to move those pieces of rebuttal, pre-filed rebuttal testimony into the record.
Please proceed.
Thank you. At this time, DEC would move into the record the pre-filed rebuttal testimony of Ms. Donna Council. Her testimony was filed on August 4th, 2023, consists of 44 pages and 8 exhibits. And there was one correction made to rebuttal exhibit 1 that was filed on August 28th, 2023. The second piece of testimony is the rebuttal testimony, pre-filed rebuttal testimony of Ms. Leslie Quick. That testimony was also filed on August 4th, 2023, consisting of 6 pages and no exhibits. And with your leave, we would move both of those pieces of testimony into the record at the appropriate time.
The rebuttal testimony of witness Quick filed on August 4th, 2023, consisting of 6 pages, will be copied into the record as if given orally from the stand. The rebuttal testimony of witness counsel filed on August 4th, 2023, consisting of 44 pages, will be copied into the record as if given orally from the stand. The correction only deals with the exhibit, correct?
That's correct.
And the exhibits 1 through 8 as corrected on August 28th, 2023, will be introduced and entered into the record.
Thank you very much.
Are there any other procedural matters? Okay, hearing none, we've come to the end of the hearing. I wish to thank all of the parties. I wish to thank all of our staff. And I wish to thank my fellow commissioners. This was a very efficient hearing, and we appreciate all of the hard work that everyone has put into this case. So with that, the orders and proposed briefs are due 30 days from service of the transcript. Also, out of an abundance of caution, any exhibits introduced during the course of the hearing but not accepted into the record are received into evidence at this time. Also, any summaries not already copied into the record will be copied into the record as if given orally from the stand and placed in the appropriate place within the record. Lastly, it's my understanding that the public staff intends to file supplemental testimony and schedules of witnesses Boswell and Zong, D. Williamson, McLaughlin, Metz, Thomas, T. Williamson, and Mishna, resolving DEC's May and June updates by October 13th, 2023. We will hold the record open for the purpose of receiving the late filed exhibits that have been requested by the commissioners and the supplemental testimony and schedules of the public staff on DEC's May and June updates. We will provide all of you with additional time to update your proposed orders or provide supplemental proposed orders on the items or matters addressed in the supplemental testimony. The date for the proposed orders will not be extended due to this additional supplemental testimony or late filed exhibits. And with that, unless there are any questions, this hearing is adjourned for now.